That's when she said to me, you know, Dawn, I'm going to write my feelings in this black book.
Diary.
And it's a diary, and she started writing. Each day she would write a little at a time.
Around the holidays of 2018, a package had arrived, a FedEx package, and in it were materials about a venture capital fund based out of the Cayman Islands. Dawn and some other family members take a look at this, and they see that Beverly is signed up for this fund to the tune of $5 million over the course of several years.
And that was really the beginning of it. That was sort of the tip of the iceberg when it became obvious that something was going on, that my grandmother really wasn't aware of this fund.
You know, Beverly started to panic. She got really upset and called, J.P. Morgan's headquarters in New York and asked for Jamie Dimon. She said she was told someone would call her back, but she says that never happened. She wrote a letter to Evan and Avi, and in there she laid out a number of things that were concerning her: unauthorized trading, the checking account. She had about $1 million worth of jewelry in a safe deposit box, and that her son Bobby had the key to that box, and that jewelry had gone missing. All this was kind of packaged in this, 5-page handwritten amendment to a will and trust.
There's such an evolving narrative about why the jewelry was taken. The only truth we really know is that the jewelry is gone. But why it happened, there have been a lot of different stories.
You just don't take your mother's wonderful things and hand it out.
And they emailed that note to J.P. Morgan to seize all activity on her account.
And it ended up setting off a firestorm after that. As soon as they got this email that there was a cease and desist and that she wanted to send her money and change brokerage firms, they were actually vacationing one floor below downstairs. They're there right now.
The next day, Beverly's in her place. The granddaughter's still in her place visiting. Dawn is there, and up comes Bobby kind of barging through the door. And he's screaming about what was sent to the J.P. Morgan. They're now investigating now. And he's furious, takes his mother and sort of puts her into a chair, gets pen and paper, and she says physically forced her to write a retraction letter.
They were pushing me around.
It was a scary time. I was really afraid, too.
I had to take her to the doctor, and she did an x-ray because she was in so much pain.
The locks had to be changed. The phone number had to be changed. I really thought we were going to have to hire guards to be outside just for protection.
Oh, it was terrible.
Horrible scene.
Beverly brought her case before the Financial Industry Regulatory Authorities, usually known as FINRA. It took several months of hearings. She sees all sorts of transactions that's going on, hundreds of them that she claims that she never knew about, never authorized, but yet were logged in J.P. Morgan's files as having been direct requests from her. That included the sale of a large amount of Apple stock worth several $1 million, as well as all her stock in Big Lots. Over the course of their time with J.P. Morgan, Evan and Avi were making all sorts of trading on her account that was generating millions of dollars in commissions for themselves and the bank, yet she was not sort of getting any of the type of gains that you would expect sort of an $80 million account in a bullish market to be able to get. They issued a ruling entirely in her favor, finding that her grandsons, as well as J.P. Morgan, they were liable for violating their fiduciary duty, misrepresenting themselves, and they also found that the bank and her grandson, Evan, were liable for elder abuse. Evan and Avi, they were fired from J.P. Morgan. They issued an award of about $19 million. I reached out for comment, and J.P. Morgan emphasized that Evan and Avi were no longer with the firm and that their actions do not represent the sort of values of the bank. I reached out to Evan and Avi, heard back from their lawyer saying that, they disagree with the law and the facts that FINRA kind of used to decide the case against them and are seeing if they can have it withdrawn. Her son, Bobby, wrote her a letter, said his sons weren't criminals, and he also admits to taking her jewelry. And he says he needed it to pay off some bad business debts he had.
They never once came up to say, I'm sorry.
If there had been an apology and some acceptance and asking for forgiveness from my grandmother, I don't think we'd be in the position that we are now.
Since the piece came out, we've received dozens of messages from people, many of whom are telling their own sort of personal tales of, kind of financial advisors gone bad, or family members who got control of an estate and abused, those within. It seems that it's really resonated with a lot of people. I keep, hearing a lot of feedback about Beverly and how, a lot of people feel she did the right thing.
You're never too old to stand up for yourself and try to right an injustice. She was adamant that she wanted to stand up for herself, but at the end of the day, they did wrong.
It's a painful life lesson. Beverly taught them that you don't mess with grandma.
On April 20th, oil markets did something they never had before, and they crashed, went into negative territory and closed the day at minus $40. Meanwhile, in a place called Thaden Boyce in Essex, a group of 9 traders, led by a guy called Cuddles, made $660 million over the course of a couple of hours.
The price of oil has collapsed to a record low.
We've never really seen anything like it. WTI this morning down more than 35%.
People maybe wouldn't have been so surprised if the oil price had fallen to zero, but the oil price went to minus 38. It went far lower than anyone had expected. And so lots of people in the market were saying, well, hang on, something else is going on here.
A couple of months later, I started to get wind through a kind of network of sources that a tiny firm in the outskirts of London had made a huge amount of money that day and potentially had some part to play in what happened.
The information we got was that 9 traders at Vega Capital London had made in the region of $660 million in one day. As a group, I think they made as much money in one day as Apple makes from its international sales in one day. I mean, it's an insane sum of money.
Did they pull off a fantastic trade? Did they predict the way the market was moving and get it absolutely right? Or was there something else going on, and had they actually done something that breached market rules in a bid to sort of push the market? And that investigation is ongoing. So Paul Commins is a trader who cut his teeth in the pits in the 80s and 90s when everyone had a nickname. His was Cuddles. If you can imagine, that was a very sort of cutthroat type of world where people are doing, hundreds of thousands and millions of dollars trades by shouting at each other, giving hand signals, and then sort of scrawling on scraps of paper.
The culture of the trading pits in London was very influenced by the working class guys who became traders there. They weren't like the city bankers that had gone before them. They weren't usually Oxford or Cambridge. They didn't wear Savile Row suits. They were ordinary working guys who happened to have a talent for trading. And a lot of them came from Essex.
I think it was 400 traders in the pits, and Cuddles in his oil and gas pit was described to us as amongst the top 3 amongst that, was very successful and made very large amounts of money as a young man. But inevitably mechanization and the arrival of electronic markets was the kind of death knell for the pits, and in 2005 the IPE closed down.
And when the pits shut down, a lot of the traders who worked there lost their jobs or quit or went to work for financial institutions. But Paul Commins decided to start his own trading collective out in Essex.
Some of them are ex-pit guys, cut from the same cloth as him. Lots of them are actually sort of in their 20s, and they're his, drinking buddy's son, or they're his own kids' friends from football. They're young lads, hungry and ambitious, and he brings them into the fold. And fairly shortly, he's got, maybe a dozen or so traders that they're independent, let's be clear, but they're all part of this collective.
Yeah, I'll let Liam deal with Essex.
I am from Essex, so I feel like I'm free to, to get into this.
Sweet, as they say.
If you were to ask someone in Britain how they would imagine a kind of Essex person, they would see someone who's maybe slightly flamboyant, with a sort of Cockney accent, a sort of Guy Ritchie-style accent. Not afraid to splash the cash, but it's probably pretty bright and has done well for themselves.
Don't even make sense, does it?
But, these guys, they drove around very nice Rolls Royces and Bentleys. They went to places like Marbella on holiday.
Thaden Boyce is a very wealthy place. You have to have considerable income to be able to afford to live in that village. It's a really nice place to live, and it's 20 minutes tube ride away from the city.
Earlier in the summer, we have this lead, which is that there's this tiny firm called Vega Capital London, and they were the biggest winners from the biggest oil crash in history. Anyone that covers markets is going to be surprised about that. You're thinking your BPs of the world or your Glencores, but it's this tiny firm.
And one of the big challenges that we had was actually finding out who worked with Vega Capital. It wasn't immediately obvious, and at first we had absolutely no idea. If you go to the Vega Capital website, it says it's under construction. If you do basic online searching, it's very difficult to find anyone who's publicly connected to the company.
So inevitably, we're incredibly curious at this point. Like, who the hell are these people?
The more reporting we did, the more it became clear that this group were connected socially as well as professionally. They went to weddings together, they played golf together, they would go on holiday together. We found out that a number of them were members of the West Ham Supporters Club in London. A few of them started companies together, so you could see all the connections between them and start to see a distinct group emerging.
And it really just was this kind of shock that, this wasn't just like a hedge fund or a firm you'd never heard of. This was actually a group of buddies who all had the same experience on this day and had all made a huge amount of money. So if you're an oil trader, there's a number of different ways you can trade, and probably the most popular is WTI futures contracts.
And it's basically a contract that says, I'm going to buy 1,000 barrels of oil from you at this point in the future, or I'm going to sell 1,000 barrels of oil to you at this point in the future.
It's actually just a financial contract to gamble on to predict whether oil is going to go up or down.
On the 20th of April in Essex, there had been signals for a while that this was going to be an exceptional day in oil markets. And we know that some of them arose early and started their trading in the early hours of the morning while it was still dark outside.
Essentially what they were doing is buying contracts that gave them an obligation to buy oil at whatever the price ended up at 2:30 p.m. So they're basically placing a bet that oil is going to fall throughout the day.
But they're simultaneously selling lots of oil as well. And whether they make a profit and how much profit they make is the difference between what they buy the oil for and what they sell the oil for. Now, of course, we now know throughout April 20th, the price dropped and dropped.
So this is going very well for them. They are committed to selling oil at these prices, and the prices are continuing to fall, which means they're going to be able to offset it and buy oil at cheaper at the end of the day. Now, once it gets to kind of 1:30, 2 p.m., that's when things start to get really interesting. Suddenly there's a kind of influx of buyers and sellers, as desperation increases in the market and trading volumes go up. Now at 2:08 p.m. exactly, something bizarre and unprecedented happened, which is that oil passes into negative territory.
And it fell to a record level of minus $38.
We've never seen anything like it, period, in terms of the contraction
of the global economy.
That huge gulf between what they were buying the oil for and what they were selling it for enabled them to make more money than they ever thought possible.
So their profit was the difference between minus 37 and all of these positive numbers on every contract they sold.
The price of crude briefly hit minus $37 a barrel. For one group of traders operating from a small office, it was a very, very profitable day.
It's important to remember this had never happened before in the history of oil trading. No one could have predicted it.
I can't think of another example of where you enter a trade and you get paid on both sides. You get paid both to sell and to buy. It's unthinkable.
One thing we know about the Cuddles Trading Arcade is that they were very comfortable taking large risks. And, you have to be clear, this was a large risk.
Yeah, we spoke to oil traders, both people that know these guys and people that don't, and they all say that this is, incredibly risky.
And that's actually what stops a lot of oil traders doing trading like this. They simply aren't willing to stomach the risk. But Cuddles and his friends were.
So when the kind of final calculations came down, the group of the 9 most profitable traders made $660 million or thereabouts between them. I mean, if you can imagine, I think 3 or 4 of them made in excess of 100 million each.
One of the astonishing things about this trade is that 2 of the individuals who made more than $100 million in a single day were in their 20s. One of them was 22 years old. Only a few years earlier, he'd been posting on his social media about doing teenage stuff with his mates in town and going to see girls and rap music. And here he is a few years later making $100 million in a single day's trading. When me and Liam discovered that, we couldn't believe it. We couldn't believe what we were seeing. Oil trading is a zero-sum game. Anytime you're making money as an oil trader, someone else is losing it.
Amongst the biggest losers were the investors in this Chinese fund, Crude Oil Treasure Fund. There were thousands of them, and they lost everything.
Lots of people had put their savings into oil funds. They lost money that day. Big banks and brokers who sort of stand in the middle of trading parties, they lost money that day.
And another interesting thing is that oil-producing countries like Kuwait or Canada, they sell oil as an average of the WTI closing price over the preceding month. So the fact that one of those numbers in that average was minus 37 meant, if you can imagine, countries like Saudi Arabia and Kuwait potentially lost a couple of dollars on every single barrel of oil they sold that month.
Vega Capital's traders made such an extraordinary sum of money that it was inevitable there would be some scrutiny of what they did. But it wasn't just the sums of money they made. In the vital half an hour before the settlement price was set, they were by far the biggest sellers of oil futures in the market, which is an incredible thing to think about when you consider that the other participants in that oil market are going to be the world's biggest banks, oil majors, BP and Shell, and here you have a group of 9 guys in Essex who are having this significant influence over a global market for oil.
I mean, I think you have to assume that if these guys had made $7 million or $10 million, they probably would be celebrating in Essex right now. But the fact that they made closer to $700 million has meant that they are facing understandable scrutiny.
We wrote individually to all the Vega traders who did exceptionally well that day, and we got a letter in response from a law firm representing the group. The law firm was at pains to point out, number one, that they haven't been accused of any wrongdoing, that they all traded independently and separately, and they'd basically all made up their own minds that this was what was going to happen in oil markets based on publicly available knowledge, and decided to execute this trade.
What I love about these stories is there's a real variance of opinion, and some people will look at what happened and think that must be dodgy. They all traded at the end of the day. They all made a huge amount of money while all these people lost. That's shocking. But lots of people say these guys are at acute disadvantage. They're in a market that's inhabited by, huge technology-driven funds and firms and oil giants that have got all the advantages in the world, and when you get a bunch of Essex geezers who essentially beat the market and find a way to make a huge amount of money, they should get a pat on the back, really, because that's the dream. Since this happened, a lot of the guys have stopped trading the monthly settlements that they'd done so well at in the past. Several of them have set up new companies. they've essentially gone very quiet. You know, any kind of social media presence they had has kind of closed down. By all accounts, they're, you know, waiting this out.
It's certainly too early to try and predict how the regulatory investigations are going to pan out. You know, we just don't know. There's a number of potential outcomes for these guys. You know, potential punishments if there are any findings of manipulation against Vega or anyone affiliated with it might be, you could be fined, you could be banned from trading, and, you know, in the most extreme cases, there have even been criminal prosecutions in the past of people who have been found to have been manipulating the settlement and misconduct related to trade at settlement. There are other outcomes too. You know, one obvious one is going to be that they're able to walk away from this life-changing trade with all the money that they made and celebrated as heroes in the trading community. That, you know, they'll go down as legends.
It's very important, given the nature of the climate crisis right now, for the general public to have an understanding of what progress is or is not actually happening. And I think many readers right now, they'll see these hundreds and hundreds of companies making these big, bold climate claims. And they would be forgiven to think that, you know, we're well on our way to meeting the emission reduction trajectory we need to be on. And the reality of the matter is we're just not on that trajectory. And a key reason for this sort of disconnect is the use of offsets that aren't doing what they claim to be doing.
We have a massive potential for sort of willful blindness. We can convince ourselves of things regardless of what the facts are. And so that's what tends to happen in these cases. It's not that anybody is setting out to commit climate fraud. They sort of walk themselves into a situation and they convince themselves of one thing, and that allows them to convince themselves of another thing. But at the end of the day, they're doing something that makes no sense at all.
My name is Ben Elgin. I wrote the story about how the billion-dollar market for carbon offsets is setting back the fight against climate change. So one of the challenges in reporting on carbon offsets and trying to figure out what's going on is really finding good experts who have been steeped in this marketplace and are willing to candidly talk about it. One of the best people for this is a fellow named Mark Trexler, and I've been talking to him for more than a decade.
My name is Mark Trexler. I've worked in climate change for the last 30 years. I was actually hired by the World Resources Institute in Washington to work on the first carbon offset project in 1988. In terms of defining a carbon offset, one of the beauties, so to speak, of greenhouse gases, sort of the silver lining of greenhouse gases, when you put up a molecule of CO2 into the atmosphere, it can be anywhere in the planet in 7 days. And therefore, you know, if there's an option to reduce emissions on the other side of the planet, and you can do that very cheaply as compared to doing it in your factory, for example, then why not pay that person, that factory on the other side of the planet to reduce their emissions? Then you are, in a sense, offsetting your emissions, and the atmosphere doesn't really see your emissions anymore.
So carbon offsets have been around for quite some time, and they were actually key with these international climate agreements, such as the Kyoto Protocol, which mandated the wealthiest countries reduce their greenhouse gas emissions.
The treaty was signed on the 11th of December, 1997.
Decided. The business community in general saw carbon offsets as a huge opportunity to comply with whatever policies and measures might be coming down the pike on climate change. much more cost effectively.
We've seen a huge surge in companies making big proclamations about how they're going carbon neutral or zeroing out all of their carbon emissions.
We're going to reduce our carbon footprint to net zero.
Unilever is committing to net zero emissions.
We can achieve a net zero emissions world.
We began looking at these corporate claims of dramatically reduced emissions, and we noticed so many of these companies were using carbon offsets to achieve these aims. And as we began to look at the carbon offset projects themselves, what we found is that the environmental benefits claimed by these companies are not actually what they seem to be. And as we sort of saw and spotted a number of these very aggressive carbon offset projects, which appeared to be generating inflated credits or bogus credits, we saw a number of them were associated with the Nature Conservancy. This surprised us. The Nature Conservancy is the world's biggest environmental group. They have about $1 billion a year in revenues, and they've been around for 7 decades. They've preserved about 125 million acres of land, and they've done so many good works over the years, and they've been very strong in terms of working with corporate partners. The Nature Conservancy has taken a different approach, a very pragmatic and pro-business approach. They will not go out and criticize a big polluter, but they're very happy to work with them. Some might say that, well, that's selling out, but others would say, and those at the Nature Conservancy would say, these companies have deep pockets. They can help fund important preservation work, and we have absolutely no problem working with them on this stuff. So companies are very warm, and they've partnered with the Nature Conservancy for many years. And yeah, it definitely lends a sheen of credibility to these projects.
Here's 20 new reasons to visit Disney World this year. 1, 2,
if you look at, for instance, Disney, that's a sprawling company with theme parks and cruise lines that burn up diesel fuel. They have office buildings and television studios that consume electricity. So these companies are trying to make major reductions in their carbon footprints, but it's very difficult to change these fundamental ways their businesses operate. So Disney has been a big buyer of carbon offsets that are orchestrated by the Nature Conservancy. One of the projects that they buy from is called Pennsylvania Ridges. And that's a plot of land. Most of the land is actually about a 3-hour drive outside of Philadelphia. Interestingly, this land, 3,000 of these acres, was actually acquired by the Nature Conservancy in the late 1990s. This land was imminently threatened. There was a pending logging contract on this land. So they do what they've done so well for all of these years, which is they go out, they raise money from local philanthropists, and they go buy this land to protect it from developers and loggers. And at the time, according to an archived version of the Nature Conservancy's website, when they were proudly announcing this deal, they said, these threats have been abated because of this acquisition by the Nature Conservancy. So it's really interesting now, fast forward 2 decades to earlier this year when they put forward this carbon project. And if you look through it, this land is a key part of that carbon project. And what they're now saying is this land is now, once again, imminently threatened. 72% of the trees are going to be cut within 5 years. Now, this is just astounding because this land is owned by the Nature Conservancy. They do not clear-cut land that they've bought through philanthropic donations. So this scenario that they've put forward to get carbon revenues is not really plausible. And what that means is when you have Disney coming in and buying these credits, when it eventually lowers its carbon footprint because of these credits, well, that won't be a credible or truthful claim by Disney. So this is an organization that truly understands the threat of the issue of climate change and is wanting to do its part to address this. However, in this situation, it just appears their drive, which they've had for decades, to increase the amount of revenues that it can use for land preservation work, Nature Conservancy and many others see that the carbon credits as a pot of money that they can tap into to further their own benevolent aims. But unfortunately, what this has resulted in is claims of climate progress that just aren't really happening. So the Nature Conservancy defends vigorously these deals, and they and others will say, look, our projects are just following the rules that these registries set up. So some would also put some of the blame on the registries themselves because they're setting up the rules which allow these vapid projects to get up and sold. So we've reached out to all of the companies we mentioned in this story, including Disney. They didn't want to be interviewed for this story, but they all told us that, look, we have to rely on the experts out there, and those experts, they say, are these carbon registries that have been set up. Most of these Nature Conservancy deals are set up and sold on this exchange. It's called the American Carbon Registry. Now, it's the oldest of these registries that allow voluntary carbon credits to be sold. They've been around since 1996. What these offset registries do is they set up rules, and any carbon offset project has to follow those rules. But there's this tension that's always there. If the rules are too strict, then it's going to be very hard for carbon offset projects to get up and running. So there's this balance going on where the registries want rules that attract projects, but they don't want it to be so strict where it will disincentivize projects from getting listed.
One of the challenges with designing carbon offset systems is that there are normally two people at the table. You have buyers and you have sellers. And to some extent, you have policymakers, but you know, the buyers and the sellers are really the ones with the expertise, with the incentive to really participate hard, make a lot of things happen. And the challenge there is that both of them sort of want the same thing, or they're both happy with the same thing. They're happy with low-cost offsets and a lot of them, because that works for their business model. You end up, though, with nobody really representing the atmosphere, so to speak. Nobody's really representing the climate in those discussions. And so the policies end up biasing the whole system. And you end up in sort of a race to the bottom. And that's what we've seen happen. You know, when it comes specifically to the topic of carbon offsets, you know, I am a fan of carbon offsets in the sense that they can help mitigate climate change. They absolutely can. But, you know, if we're not going to do it correctly in a way that actually does help mitigate climate change, then it's nothing but a distraction. And, you know, after 30 years, you have to start wondering, is it really just a distraction? And that's really unfortunate, but that's where we are. Ultimately, what needs to happen is systemic change. You know, we're sort of nibbling around the edges with some of these different things. We need to change how we produce energy. We need to change how we transport ourselves. We need to change what and how we eat. You know, we need systemic change associated with transitioning to a low carbon economy. A lot of what we're doing today is not promoting systemic change. It's sort of trying to stick your thumb in the dike to preserve the current system. And at the end of the day, that can't really work.
the Hyperloop. There's a good chance you've heard the name by now.
This is the Hyperloop system. It can take people hundreds of miles in minutes.
The Hyperloop, a series of tubes that would transport people in pods at ultra-high speeds over long distances.
It's a remarkable new form of transportation that can whisk people from city to city in a flash.
29 minutes from New York to D.C., 30 minutes from L.A. to San Francisco.
For years, we've been seeing these futuristic, utopian renderings of some cross between a spaceship and a monorail. But lately, the Hyperloop is becoming much more real.
Yes. It was surreal to be even sitting inside a Hyperloop, and just even more incredible to actually be like riding down a track in something that was nothing more than a crazy idea 6 years before.
Companies all around the world have been developing and testing the technology needed to propel passengers at speeds of over 1,000 kilometers per hour. But for many, speed is only the first step to unlocking the full transformational effects of a new mode of transportation.
Fast is what we just sort of take for granted in the Hyperloop world. It's the network effects that really deliver the benefit. And that opens up a completely different scale of economic opportunity.
We've got planes, trains, automobiles, and boats for getting around Earth. But what if there was a fifth mode? And I have a name for it, which is called the Hyperloop.
The Hyperloop?
Hyperloop, yeah.
In 2013, while riding high on the growing success of Tesla and SpaceX, entrepreneur Elon Musk released a white paper outlining the basic framework of the technology he called Hyperloop. The basic idea goes a little something like this. A tube reduces the air pressure to a near vacuum-like environment. A Hyperloop pod is then suspended in the tube, usually by magnetic levitation. The whole pod can then be propelled forward. Because there's no traditional friction sources like air resistance or rolling friction that would push back against the pod, the Hyperloop is able to move at incredibly high speeds and do so fairly efficiently. Despite its futuristic name, however, the general concept behind Hyperloop is actually pretty old. In fact, New York City's first attempt at an underground public transit system in the 1870s was based on a similar principle. The pneumatic transit system was short-lived, however, only stretching one block and topping out at a rather leisurely 10 miles per hour. While Elon would make some 21st century improvements to this concept and bestow a very 21st century name, he wouldn't end up pursuing the technology itself, instead electing to focus his efforts on something a little bit deeper, literally digging the requisite tunnels via his boring company. It would take another billionaire industrialist who dabbles in spaceflight. No, wait, not that one. Yeah, that's the one. After Richard Branson would make a large investment in the company Hyperloop One, it would be renamed to Virgin Hyperloop.
What we've always been trying to do as a company is show that this technology could work, that it could be made safe, and that ultimately it's something that's happening in the next couple of years, not the next 20 years.
Josh Geigel is the co-founder and CEO of Virgin Hyperloop. In a familiar tech startup story, he's seen the project go from a garage to a large-scale testing facility outside of Las Vegas.
So we started building the first kind of Hyperloop system in 2016. We've done a lot of work, about 500 tests that we've done on that over the last 5 years. And what we realized that we need to do is take that technology, show that it can be commercial, so drive the cost down, improve the efficiency, improve the performance. But the key thing is actually making it approachable and safe for individuals.
In order to do that, Josh, along with Virgin's head of passenger experience, Sarah Lucian, bravely volunteered to take the inaugural ride.
What her and I were realizing is we're the first two people sitting in a Hyperloop. The only type of people that have gone through this environment are in spacesuits, and there we are in just normal clothes because of the system, the safety of what we've designed.
3, 2, 1, launch.
And then once we started going, you felt a bit of acceleration. We accelerated a little bit harder than we would in commercial. It'd be like a sports car. Yes. We got to about 108 miles an hour on that test. And it's a short run. It's about 500 yards or so, and came to a stop.
The test, lasting only about 20 seconds and covering only a quarter of a mile at just over 100 miles per hour, is a long way away from a true functioning Hyperloop. But as for optics, it's a crucial step for the future of funding.
The number one question we got from investors or from project proponents or just people in general was like, is a Hyperloop safe? And what better way to show something is safe than by actually getting people on it?
But convincing investors and governments that would likely be fronting some of the construction costs for an unproven technology is no easy task. First and foremost is the question of safety.
Most people don't know how an airplane works, but yet they get on an airplane. They get on an airplane because, it's faster than driving, and most importantly, they've probably gotten off of one before, they've seen someone get off of one before. And so what we set out to do was actually show that Hyperloop could be safe with two normal people, not astronauts, not adrenaline junkies or test pilots or anything like that. Two normal people getting on a Hyperloop, and then most importantly, those two people getting off.
But beyond safety concerns, constructing Hyperloops will undoubtedly require a significant capital investment to the estimated tune of around $60 million per kilometer of track. So a track from San Francisco to Los Angeles, for example, is likely to come with a price tag over $10 billion. And before large governments are willing to come in and front those costs, investors who are funding Hyperloop development must accept it as a long-term mixture of technology and infrastructure investing.
Investors that are used to short returns because you're developing apps or something to that effect, those aren't the investors that really get excited about Hyperloop. What you start to see is the people that are looking at platform technologies, right? So this idea that because the smartphone existed, Uber could exist, right? So who are like the Vanderbilts of this century? And that's the part where you're going to get a lot more no's than yeses. But there's people that have the ability, the fortitude to stick it out, to see the game-changing platform here. Those are the people that we're looking for. And since we've done that passenger test, there has been a lot of interest that's really, this is a lot sooner than I thought.
Envisioning the ripple effects of what Hyperloop could achieve, though, is fairly challenging at this stage of development. It's fast, yes, but for point-to-point travel, traditional maglev trains can move pretty fast as well. And outside of China, South Korea, and Japan, even those haven't seen much adoption elsewhere due to the high costs and questionable profitability. The Shanghai line in China, for example, loses around $100 million every year. Hyperloop companies, however, believe they can offer something different than traditional railway lines.
My name's Alan James, and as far as I know, I'm the only guy on the planet who's written a government-level business case for 300 kmh conventional high-speed rail, 500 kmh maglev, and 1,000 kmh Hyperloop. It's fundamentally about moving people from where they are to where they want to go, when they want to make those journeys, and doing it in much smaller numbers. So pod designs for Hyperloop range from 12 to 28 seats, typically. Why are they small? It's because small enables the network to operate flexibly. And a great example of that is the east-west strategic route across the north of England, from Liverpool to Manchester to Leeds. So to get from Liverpool via Manchester to Leeds by train is just short of 2 hours today. It'll probably take you 2 hours driving as well in average traffic conditions. Net result is those three city regions remain three separate entities: Liverpool, Manchester, Leeds. There's very little commuting traffic between those urban areas. Hyperloop absolutely changes that from the ground up. Liverpool to Manchester is a 5 or 6 minute journey. Manchester to Leeds is also a 5 or 6 minute journey. What that effectively does is create a single supercity economy.
In this vision, the Hyperloop acts a little more like a highway, where pods have fixed destinations and don't need to stop along the way. Meaning you can travel on a Hyperloop network from, say, Liverpool to Leeds, while the pod behind you travels from Liverpool to Manchester. And if that metro Hyperloop network is connected to other networks from the same location, you could travel from Liverpool to Paris or Liverpool to Amsterdam, all without making a single stop.
For passengers, for business, for leisure, that is utterly transformational. For high-value freight and logistics, it's equally transformational. But critically, if you do a Hyperloop network at scale, you begin to deliver massively significant carbon savings too.
A multi-regional Hyperloop network could become a replacement for both short-haul passenger and cargo flights and traditional ground transportation, both of which are significant carbon producers.
One Hyperloop-connected distribution hub, perhaps at an airport that is predominantly used for international air freight, replacing maybe 10, 12, 15 distributed road hubs. It takes a lot of polluting and inefficient truck haulage off the roads. That itself means roads gain extra capacity.
Hyperloops will still need to use electricity to both move pods and maintain the near-vacuum environment in the tube. Proponents of the technology believe that this can be done by using renewable sources, including a combination of solar panels and battery technology that could be used along the Hyperloop itself. But even with all multipliers of time and carbon emission savings that a Hyperloop network may provide, the investment capital required to actually build such a network becomes even more economically and politically daunting.
Committing doesn't mean spending billions on day one. Committing means, how do we phase it?
One company in the Netherlands is working to develop that technology, and perhaps more importantly, the international coalition needed to make the Hyperloop network a reality.
So we are here in Europe's first full-scale Hyperloop test facility, where we can already prove every conceptual technology of the Hyperloop.
This is Tim Houter, a co-founder and CEO of Hart Hyperloop, headquartered in the city of Delft. And while this testing tube might not seem as large as others, inside is a key technology to create the on- and off-ramp type infrastructure of a Hyperloop network. That is, a lane switch.
That's something we can already test here. You can actually see it here, that the track is diverging from one track into two. That makes it possible to eventually split up the Hyperloop track in two sections. And in that sense, you can create a complete Hyperloop network that in the end will make it possible to travel, for example, over a whole continent. Take Europe, for example, with the same ease as you can now travel with a metro in a city.
The nice thing about this magnetic levitation system that we've developed is that there's absolutely zero moving components in the track. So for example, if you have to do a lane switch, all you do is that the tube basically splits up, and statically the tracks also split up. And whenever the vehicle enters a switch, it either pulls itself to the right with its magnets, or it pulls itself to the left with its magnets.
Lane switching on traditional rail requires the physical movement of the rail. Even modern magnetic levitation tracks use lane switching techniques in order to transfer trains from one track to another.
And this is a very crucial element, because this is the thing that limits the capacity and, in the end, the usefulness of the rail network. Because the moment that a track is switching, that means that at that moment you are creating an unsafe environment for the trains behind it. So you need a lot of space between trains. But in a Hyperloop, because you have no moving components in the track, all the vehicles can be much closer to each other. You can achieve a very high frequency and basically have your vehicles moving and merging in and out of the network very much like a highway.
For now, though, Hart's physical testing has been limited by the size of their tube. Because the test track is only 30 meters long, they haven't tested this lane switch at speeds greater than 20 kilometers per hour. However, the company is working to build a new test site where it plans to increase that testing speed to 300 kilometers per hour.
We're now in a phase where we have proven most of the most important technologies in the test facilities that we already have. And we have also demonstrated the viability and the feasibility of a network. If you look at all the subsystems that it consists of, most of those are proven systems, already demonstrated in lab conditions. So we don't really believe that the technology itself is going to be the biggest challenge.
Because for all Hyperloop companies out there, actually building a Hyperloop system requires more than just a good product.
We're talking about the safety aspects, we're talking about integration into the environment, we're talking about the social aspects. Do people feel comfortable traveling in such a system? So it's about all these different aspects, and the complexity is really getting all the different stakeholders that are relevant and that do need to contribute to bring this to market, to get them all following the same roadmap.
In order to help build this coalition of private and public interest in Hyperloop development, HART in 2018 partnered with other Hyperloop companies from Europe and Canada. The goal was to define, establish, and standardize the framework to regulate Hyperloop systems.
Right now we are working with all the Hyperloop developers together in setting up the first, let's say, structure for starting the standards drafting.
One of the most important goals for HART is interoperability, which is essentially making sure that different systems can communicate with each other.
Interoperability is so important because what we want to achieve is actually have this seamless travel experience. So you don't want to end up, for example, going from Madrid to Paris and then switching because you need to use a different technology to get, for example, to Amsterdam.
The idea being that as companies around Europe create the first commercial Hyperloop tracks between individual cities, one day those can all be connected to a larger network.
Everyone that believes that Hyperloop is a future transport system also realizes that there is a need to have this network because that's where Hyperloop thrives.
Hyperloop is such a huge project. It's definitely not something that you can do on your own or as a single company. So you need to do it with a lot of other companies. You need to have the governments. I think in that sense, the biggest challenge that we've encountered is to really get all the required parties together to take the steps in development and in commercial implementation.
The idea that there's multiple Hyperloop companies, I think, is a redeeming aspect in the business. People really want to see something happen, so having multiple people move forward is good for that.
I was struck when Josh and Sarah rode the pod. 2 or 3 of the major outlets used the phrase, "We now have a new mode of transport." And although all of that technology had existed before those 2 human beings rode it, it was the moment at which those 2 human beings traveled that short distance down the tube that in popular imagination, Hyperloop became a mode of transport.
The metaphor I use with my team is that, the Wright brothers were first, but none of us fly on Wright Brothers Airlines anymore. If you don't continue to innovate, you're not going to be around, and so we'll continue to be at the forefront of building Hyperloop.
Back in 2013, Elon had an idea. I think the difference now in 2021 is some brilliant engineers have spent real time grinding out the details. And I thoroughly expect the next 3 to 5 years to be decisive.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
Hydrogen technologies are not new. They are used in other sectors. We use them in space, on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
From Bloomberg's global headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. It's a new year, so here at Bloomberg Green, we're highlighting new solutions in the fight against climate change. And one of those is as old as the universe itself, hydrogen. It's the simplest element around, but could well be a game changer when it comes to turning around our dependence on fossil fuels. Today, hydrogen is used in the chemicals industry to produce petroleum products. It's also starting to be used in steel production, an industry under a lot of pressure to decarbonize. But it has far more uses as well, from powering cars to heating our homes. And Bloomberg New Energy Finance sees a seismic shift in the sector in the next 10 years as green hydrogen squeezes out dirtier alternatives. So-called gray hydrogen dominates today. But as renewable electricity gets cheaper and more accessible, so will green hydrogen. In this week's edition of Bloomberg Green, we'll explore what this push into hydrogen means for tackling climate change. We'll hear from Australian billionaire Twiggy Forrest about his pivot from iron ore to hydrogen, and we'll also speak with the CEO of Italian utility company Snam about his book, The Hydrogen Revolution. But first, what are we using hydrogen for? And why does it actually matter? Christine Lee Edwards explains.
Hydrogen, the most plentiful element in the universe.
On Earth, we find it mostly bonded to oxygen in the form of water, or in other gases known as hydrocarbons. Hydrogen gas, H2, burns hot and clean, making it an attractive tool in the race to net zero. But isolating hydrogen from other elements is no easy task. Today, the cheapest way to do this is via chemical processes that break up natural gas. This releases a lot of carbon dioxide. Another method is to use electricity to split water molecules in a process called electrolysis. Although there is no carbon byproduct, a lot of electricity is needed. And if this power comes from burning coal or gas, it negates the zero emissions goals of using hydrogen to begin with. Hydrogen produced in this way, powered by fossil fuels, is called gray hydrogen. If carbon capture and storage is used together with fossil fuels, then it becomes blue hydrogen. If nuclear power is used, it's called pink. And finally, green hydrogen is when it's produced via electrolysis and powered from renewable sources. This method is considered emissions-free. It's predicted that by the early 2030s, H2 made from renewables will be cheaper than that made from fossil fuels. But that hinges on the cost of electrolysis declining, which will be achieved through larger projects and an expansion of manufacturing. To be clear, vast amounts of H2 are already used today. Global production in 2018 totaled 117 million metric tons. This hydrogen is mostly used for its chemical properties, not as a source of energy, and very little of it is clean. Some sectors like steel could start using hydrogen for these chemical properties, replacing coal. Industries like cement and glass may also use hydrogen as a source of heat. Another advantage is its energy storage potential. It can be stored over long periods of time and used when more power needs to be added to the grid. It also could hold an advantage over batteries in heavy transport and shipping. The promise of hydrogen for energy has been around since at least 1874, when Jules Verne wrote about it in his book, The Mysterious Island. But the future of hydrogen will depend on policy. Countries with net zero targets, carbon pricing, and hydrogen strategies with investment mechanisms are likely to see the highest H2 demand.
That was Bloomberg's Christine Lee Edwards explaining what hydrogen means for the energy transition. But how are businesses approaching the sector? Well, one of Australia's richest men is making a big play into hydrogen. Andrew Forrest, better known as Twiggy, made his fortune from iron ore, being the chairman, former CEO, and major shareholder in Fortescue Metals, one of the world's biggest miners. But after having made over $10 billion in profit from the metal in the last fiscal year, Twiggy wants to transform Fortescue into a clean energy company. He's been scouring the planet in search of investment opportunities in hydrogen and renewables. The firm plans to allocate up to 10% of its annual profits for green energy investments and is exploring projects across the globe, from Indonesia to Argentina. Francine Lacqua caught up with Twiggy Forrest.
There's only one type of clean hydrogen, all the rest is dirty.
Yeah.
That is green. If you just say green hydrogen is clean, the rest is dirty, then you've actually nailed it. And, you know, anyone else who produces any other rubbish, any other argument, just look them there and say, why is global warming accelerating if anything you're saying is true? And then you'll know, actually, it's greenwashing.
Yeah, but there's a lot of greenwashing because I keep on being told it's a transition. We can't just, make the transition at a click of a finger. So what are we doing wrong? What can we do better?
I don't remember the personal computer having to transition the typewriter. I really don't remember that. I don't remember the smartphone having to transition the pocket calculator and the old landline. You know, its transition line is complete rubbish. The lie got put to it 2 days ago when JCB, a really loved British company, every right for the country to be proud of JCB, and Fortescue, holding a bit of a similar reputation, fantastic track record, everyone's been super well from Fortescue, huge balance sheet, super strong. When those two companies got together and agreed a $79 billion US agreement per annum, right, then that's a real wake-up call to say, hang on, green hydrogen is obviously commercial now. You know, every other form of fossil fuel hydrogen, you know, it can compete with it on price, it can probably lose on price, but what we know, it is cooking the planet. And only green hydrogen zero methane, zero carbon in the supply chain. Don't worry about the molecules in the supply chain.
But at the moment, we're not even phasing out coal, if you look at the G20 communique. So we have a long way to go to talk about only using green hydrogen.
Yeah, so look, I have a call, which I'd like to make now, that the world should not fund any more coal-fired power stations, coal mining projects, ever. We should wind them down as quickly as possible because they are cooking the planet just like grey and blue hydrogen is cooking the planet.
Yeah.
You know, hydrogen, which is not made from renewable electricity, is releasing 10 to 16 times more carbon, let alone the methane, which is worse, than it is hydrogen. So we've just got to stop doing things which are self-harming under the guise of greenwashing.
So why are leaders so slow? Even if you look at the appetite for ESG investments, they're growing exponentially, so are emissions. So where are we allocating capital?
Okay, so take the recent G20. There's probably a reason why there wasn't strong action coming out of the G20 because people were not aware that major transactions between large companies were taking place now on green hydrogen, that actually this pollution-free all the way through the supply chain fuel was now being transacted at multi-billion-dollar scale. If they'd known that, I don't believe any sovereign leader or any energy minister or climate change minister could not take ultra seriously that green hydrogen is now here to stay. It's broken through. History has been made. It will never go back.
Okay, what is the one thing that you would tell leaders today and business leaders? How do we transition faster than what we are now because we're at real risk of missing our targets?
Oh, so that's really simple. You stop funding, you stop subsidizing, you stop using money into fossil fuels. It could be carbon sequestration, it could be fuel rebates, could be anything. Hundreds of billions of dollars getting ashed while we ash the planet on fossil fuel subsidies. Because we haven't had that renewable electricity, we haven't had that green hydrogen, it's kind of been pushed down. It's all sorts of excuses. Oh, it'll never be commercial, it'll never be supplied in the quantities we need it, you know, blah, blah, blah. Now we know, let's take action. It's practical, it's implementable, let's do it now.
Okay, if we do it now, is there going to be a shock to the energy system? Is there going to be a shock actually to economically? And is it worth, not talking about transition, just going from A to B?
Yeah, it's a fantastic question. A to B is the solution. Let fossil fuels do what fossil fuels do. Just burn their coal, burn their oil, burn the gas. At least they're pumping up carbon and methane into the atmosphere, honestly. Well, not that honest because they don't measure methane, which is 90 times worse than carbon. But at least the carbon is being done honestly. Encourage the green hydrogen sector to come in really fast. Okay, it's there. There's renewable power all over the world. We now know how to make electrolyzers much cheaper, like 25% of the original cost. We know how to do that now. We don't have an excuse to get into it.
Does it need to be cheaper than oil and fossil fuel for it to be viable worldwide?
Well, right now it is. Okay, so let's just swallow that bit of financial data. Right now it is cheaper, and it's getting more cheap. It's the only fuel you know
Mr. Force,
which is declining in value.
You don't have enough of it, right, to power the world?
Yes. That's only because we haven't had policies to support it. If we had policies to support it 5-10 years ago, it would be everywhere. You'd see the global warming budget start to come down. Now, we've got 5 or 10 years to make a huge difference. I need policy leaders all over the world to appreciate now, okay, big business is transacting with green hydrogen in multi-billion-dollar agreements. We now know it's here and it's here to stay. Let's spread it everywhere.
Coming up on the program, the hydrogen revolution. We'll speak with the CEO of Italian utility firm Snam about his new book and why he thinks green hydrogen will be competitive in just 5 years. Plus, how are airlines working to become more sustainable? We'll look at how Airbus plans to step up in the climate fight. This is Bloomberg Green. From Bloomberg's World Headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. What will the world look like in 2050? Will global temperatures have stabilized, electric vehicles be abundant, and solar and wind power homes around the world? According to Marco Alvera, the CEO of Italian energy company Snam, that vision of the future could be a reality. And he says that hydrogen will pave its way. As he tells it in his new book, The Hydrogen Revolution, Alvera's moment of reckoning came in November 2018 when he tasked the Snam Scenarios team with studying how Europe could reduce its CO2 emissions to zero by 2050. Looking through the results of the study, Alvera said he was struck by how much hydrogen was in Europe's energy mix by that year. Beyond the abundance of hydrogen, the Snam model also predicted that it would be the cheapest form of decarbonized energy for many sectors, and that it could be cheaper than today's prices for oil, coal, and nuclear power. Our Maria Tadeo spoke with Alvera at COP26.
It's happening all very fast. We see the cost of hydrogen coming down a lot. Hydrogen will play a big role in the energy mix. I don't know if it's going to be 15 or 25% of a fully decarbonized energy system, but it's going to be big. Costs are coming down, and people are waking up to the fact that it's the only way to decarbonize certain sectors, so-called hard-to-abate sectors.
And you say it's the only way and the costs are coming down. Where do you see prices moving? Because a lot of the reticence at times has to do with the pricing, that some argue, well, it's still not the cheapest option on the market.
So when I was first working in hydrogen in 2004, it was costing $1,000 per megawatt hour. 2010, $600. Today, $100, and we see it going down to $50 in 5 years' time, and to going down to $25 per megawatt hour in the next 10 years or so, which is a quarter of where it is today. That's really because renewable energy, and we're talking green hydrogen here, renewable energy costs are falling, but the cost of making the electrolyzer, which is the kit that you use to convert solar or wind energy and water into hydrogen, the cost of this kit is falling a lot because it doesn't really exist on an industrial scale. So as we build up capacity, we industrialize it, we standardize it, and we squeeze costs out. That's really the cost trajectory.
And for that, of course, you need demand, however, for governments and also institutions to kind of buy into this idea that it is the future and we want to invest and create infrastructure. What are they telling you? When you speak to governments, when you speak to officials, are they keen on this?
They're very keen. So the Department of Energy shares our view in the States of getting to below $1 a kilo, which is $25 a megawatt hour. The European Union has a hydrogen strategy, which is very clear, and several member states have the same. Chile wants to export a lot of hydrogen. China's big on hydrogen. Australia is very big on hydrogen. Japan is blending already hydrogen. So I would say the world is now really focused on this because it's the only way to store energy for a long period of time economically is to convert it into either a liquid or a gas.
And of course, you talk about the price, but the other big component is the volume. You know, how big can you go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to oil and gas, which are concentrated in few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
As I said, $50, which is essentially oil parity within 5 years. And then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big, big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit, and even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling cost of renewable and hydrogen. India's burning 80 gigawatt of oil, of diesel, to keep the lights on. So there's an immediate opportunity there, and we're very interested in working that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very important. At the G20, China was clearly behind the 1.5 degrees. So I think a lot has been achieved between the G20 and COP. And I think what's really important is to see in the coming years how quick it's in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the projects. The capital is there. We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where companies like us step in.
Marco Alvera, CEO of SNAM there, speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved a target of achieving net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
How long until we can fly emission-free? Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line. We'll speak with our Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. From Bloomberg's World Headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source, and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah, so for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and this is Bloomberg Green.
The great sci-fi art of the mid-20th century teased a vision of the future with one distinct element in common: a life for humans in outer space. Whether vacationing on an exotic new planet or commuting to the moon for business, space travel seemed like it was just around the corner. Yet here we are, a half-century later, and only about 500 human beings have ever left the bounds of Earth's atmosphere. But thanks to a set of ambitious private companies betting on the promise of space tourism, that long-awaited future could be here sooner than we think. For most of the history of spaceflight, governments have been the prime force behind nearly every aspect, from planning to funding to crew selection. But as early as the 1980s, proposals for commercial space tourism began to emerge, along with innovative solutions for getting people there, such as the wild concept of sticking a 74-person passenger cabin in the cargo bay of a NASA space shuttle. Although various non-astronauts have been selected for missions over the years, true space tourism didn't happen until 2001, when an entrepreneur named Dennis Tito coughed up an estimated $20 million to hitch a ride with the Russian Federal Space Agency for a week-long vacation aboard the International Space Station. 20 years later, we're seeing a new contender in this final frontier of tourism: private companies.
It's becoming a private enterprise situation. Still very high risk with a high reward, potential reward. But, government is really out of the business of flying people now, and it's really going to be companies like Elon Musk and Jeff Bezos and Richard Branson that do that heavy lifting. Commercial space tourism is usually about taking the non-astronaut, the private citizen, into an orbital or suborbital flight. So you get a short amount of microgravity experience, and you can float and take some photos, and then you come back. This was something that technology had gotten to a point where the private sector was going to make a business out of this. There are multiple companies that want to get to the place where they fly people into space.
The first of these is Blue Origin, founded in 2000 by Jeff Bezos. Using the autonomous rocket system New Shepard, a tribute to the first American in space, Blue Origin plans to launch up to 6 passengers at a time, offering a rarefied treat of 62-mile-high views and a momentary experience of weightlessness. Booking officially kicked off in May 2021, with the very first seat to be auctioned off for charity. Meanwhile, Richard Branson's Virgin Galactic has also been pursuing a viable form of suborbital tourism, aiming for a launch in 2022 once Sir Richard himself has taken a flight.
I'm hoping to be able to go to space. I'd love to be able to coincide it with the moon landing and go to space. So I've got the whip on the team, and we'll see how we go.
The company claims to have lined up over 600 seat reservations so far, including Justin Bieber and Leonardo DiCaprio. Virgin has projected that the final cost of the ticket will be at least $250,000, or roughly $50,000 for each of the 5 minutes or so of weightlessness that you'll get to experience. Although costly, both companies' offerings aim to make suborbital flight a regular form of adventure travel, eventually driving down costs at scale to expand the customer base beyond the orbit of celebrities and billionaires. The third major contender is Elon Musk's SpaceX, which has set its sights even higher on orbital flights, which are
a whole nother level of complexity and energy and danger. When you go suborbital, if you're just going to go up above the von Karman line, which is 100 kilometers or about 62 miles, you only need to get up to maybe 5,000 miles an hour to get up there, and you go basically straight up and then straight back down. You don't have the reentry heating that you would see coming in from an orbital. So when you go orbital, I don't care if you're a baseball or a battleship, you've got to go 17,500 miles per hour, not just 5,000 miles an hour. The energies involved are much greater. By doing that, SpaceX has gone another level up, and that's what they're doing with the Inspiration 4.
Visit inspiration4.com for your chance to go to space.
Inspiration 4 is the first planned all-civilian mission into orbit, slated to launch in late 2021. The crew will bring their own set of diverse perspectives and backgrounds and experiences to test how a group of different people, namely people who aren't professional astronauts, could fare in space.
Until now, astronauts have had to be physically perfect, and this mission is changing that. And so I feel incredibly honored to be representing those who aren't physically perfect. At age 10, I was diagnosed with bone cancer, and I was treated at St. Jude Children's Research Hospital. And I spent a year there undergoing intense chemo and also surgery that ultimately saved my leg. I now work at St. Jude as a PA, a physician assistant, and I work with leukemia and lymphoma patients. The kids we work with are so brave, and they are very excited to watch me go to space because this is showing them that, you know, they're capable of doing this as well.
Haley, along with 3 other crew members, will spend 3 days in space, orbiting the Earth every 90 minutes before landing back off the coast of Florida.
Well, when you think about access, the first astronauts for the United States came from the test pilot side. And so women weren't allowed to be a part of that. We have somebody in their 20s, somebody in their 30s, somebody in their 40s, and somebody in their 50s. And so there can be access in all kinds of ways, whether you're talking about age, whether you're talking about gender, whether you're talking about race and ethnicity, and all of those things.
The first time, people are going up into space and not sent there by a superpower like the United States or Russia or China. Well, that's like really significant. And you've got to be very thoughtful about it. The whole game plan right now is to make space like really affordable and accessible for everybody, so that you can have fishing buddies going to space someday. But the first is special, and so with that, we wanted to have a crew selection process that could make space available to everyday people.
Getting to space is only the first step for space tourism. The next challenge is what to do and where to stay when you get there. Axiom Space is planning to launch the first segment of a new commercial space station in 2024. Their $2 billion project, called Ax Station, will become the first free-flying private international space station. Or, to use a more consumer-friendly term, a space hotel. Axiom isn't the only company out to make your space stay a little more comfortable. Bigelow Aerospace has been building what they call expandable habitat technology, like their B330, an inflatable pod module that expands once in orbit.
There's even one attached to the International Space Station right now they've been testing. And you take it up and it's rather small, and then you inflate it, and it seems to be working very, very well. This is likely to be the first kind of tourist hotel that you're going to see up in space. First of all, it's easier to carry instead of this giant tin can with all of that. The inflatables are lighter. You can just blow them up, and they get a nice big size for about less than half the weight probably.
But even as space missions become accessible to civilians,
the risks of going into space are incredibly high. And you could die 1,000 ways that we can think of and 1,000 other ways that we can't think of.
This is Michelle Hanlon. She's a space lawyer at the Mississippi School of Law, focused on protecting humans in outer space.
Now, I'm not an attorney for any of the space tourists, so I haven't been privy to their private contracts. But I can tell you that the FAA requires certain waivers to be in those contracts. So, for example, the FAA says, well, we're not going to make you make your spacecraft to a certain safety level. We are going to make you, spacecraft operator, make sure that you inform your space tourists of all of the hazards that you know of. I'd imagine a very long waiver, all the ways you can die in space. And you have to understand that there's health risks, and you have to indemnify the US government if you are launching from the United States. So those are things that we know a space tourist has to sign and has to waive. So now let's go back and think about our space flight participants. The FAA calls space tourists space flight participants. They don't call them astronauts. Why is that important? If you're not an astronaut, there's no obligation to rescue you if something goes wrong. It's a lot of money to set up a rescue launch. If it can even be done, it's something really important to think about, and that difference as we cross this threshold from having astronauts in space to having real people like me in space.
And when we are able to make it to space reliably enough, there's still a host of other legal and ethical issues to consider before space tourism can truly take off.
There are so many gaps in space law that we are going to have to put in a lot of sort of basement ideas. And so, for example, the Outer Space Treaty is a treaty that offers principles and guidelines for state activities, for the activities of national governments. It doesn't talk about private entities, it doesn't talk about humans in space. So now if something goes wrong, so let's think about all of the times hotels on Earth are sued, right? So slip and falls, you step on something in the bathroom, you sue the hotel, and it becomes a private lawsuit. Because of the vagaries of international law, If something happens in space, well, boy, you can sue the state that launched your spacecraft. You can sue the company that brought you there. You can sue the hotel. You can sue the individual. You can sue every government related to that, because the way the Outer Space Treaty and the Outer Space Regime have set this up is that anything that happens in space first has to go through a diplomatic channel before you think about suing in a court of law. And so every single slip and fall in a space hotel is a diplomatic nightmare. And so we really need to figure that out before we start sending a lot of people there. You think about human rights in space. Here, we don't think about a human right to oxygen because it's kind of all around us and free. It's not in a space hotel. So what happens if something happens and the oxygen depletes? Who gets the oxygen first? And then, of course, let's not even think about the labor. How do you treat your labor in a space hotel where that person may be there for 2 or 3 years without coming back to Earth? So a lot of things to think about.
Space habitats are more likely in the near future to focus on research missions and be a home for experiments that can't happen as easily back on Earth.
Space hotels, I think they garner a lot of headlines and a lot of news, but at the same time, that's not the first thing that you're going to see happen. They don't offer the compelling business case, I think, that you'll see from a place that wants to manufacture pharmaceuticals or a new type of crystal or some type of filament or fiber optic cables and other things that you can do in microgravity. The things that are actually, a high value finished good, when you get that back to Earth and you sell it for a very, very huge profit margin. That's what's likely to happen in space, as opposed to having a real estate platform that you sell to a tourist. A space hotel is really interesting, and it will probably happen, but it's not likely to be at the forefront of space commerce.
Even if space hotels are right around the corner, don't get too excited about booking a trip in one.
It's not a cheap ticket to ride to space, and it's going to be, millionaires and billionaires and that sort. But at the same time, the point was made that in the early days of airline trips, that was also a completely unaffordable ticket for most people. Those people who flew were people of means, and over time it becomes affordable to the masses. And I think that's the goal for all the entrepreneurs in space as well, to get those costs down to a point where it's not $10 million or $5 million or $300,000 ride into suborbital space. When it becomes more like buying a first-class ticket to go to Europe from the United States. So that's the goal, and the question is, can we get to that point?
Given the immense operating costs of getting to space, it may be years, if ever, until space tourism becomes a profitable venture for any of these companies. Virgin Galactic, the only publicly traded company of the three, has had a particularly rocky year, initially riding on the momentum of a SPAC deal, but more recently beset by launch delays and major funders, including Branson himself, selling large quantities of their stock in the company.
Space is really, really, really hard, and it's an absolute cliche, but it's one that happens to be very true. It's just really hard to do. That's also the reason that you've seen the delays that, Virgin had talked about flying years and years ago. And it became such a crazy point that Richard Branson actually stopped talking about it when he was asked, because it was never going to be when he predicted. But it's not insurmountable. And, investors have stepped up because this is something that is doable.
Despite the astronomical dangers and costs of getting to space, it may ultimately follow the course of other once fanciful modes of travel.
Wright brothers having, what was by modern standards a very unimpressive first flight, at Kitty Hawk. I mean, you had less than 20 years later, you had your first airborne ambulances being used to save lives. Fundamentally, the world is a more interesting place when people can go and dance among the stars and such.
The lure of space is innate. It's in our DNA. It's that exploration bug. We are an exploratory species, and we want to go out there and see what's out there.
That vision that I had in 1969 of seeing normal human beings travel into space, it's finally beginning to happen. When you get a bunch of people up there and they can all see it for themselves, that'll create even yet another revolution in how we treat our planet and the way we think about it.
So while 2001 came and went without quite looking like Stanley Kubrick's ultimate space fantasy, 2021 might finally be the year we're catching up.
If you visit California, you might be inclined to go to Disneyland, or jump in your convertible and take Highway 1 up the coast, or maybe make a pilgrimage to Yosemite. All very fine choices. But if you're the kind of person who revels in our planet's extremes, then it's Route 395 that you're after. This one glorious road will carry you from Death Valley's desert floor to sky-high views of Mount Whitney. You can see the 5,000-year-old bristlecone pines, the oldest living organisms. Or the bizarre tufa towers of Mono Lake. And true to California's boom and bust spirit, you can saunter around the ghost town of Bodie. What a novel experience to find an empty American city where all the businesses are shut down. To do 395 upright, it helps to have a guide, and mine is a man named Jan, and his crew, Heron,
Let's tidy up first.
and Lemmy, the hardest partying dog of all time. Jan agreed to show me some of what 395 has to offer, but only if we agreed not to disclose any locations.
My name's Jan Swirstra. I'm an industrial designer out of LA, and I spend a lot of time camping and a lot of time in the Eastern Sierra. It's a place I love, and sometimes I'm known as 395 North because my Instagram account, and I don't like to be known as that, but I'm trying to use it to set a good example and do more with it than just social media.
Where did we end up camping? We got here late last night. I wasn't even sure where we are.
This is BLM land, right on the outskirts of National Forest, and it's one of my favorite places in the world. Basically, everything outdoors wrapped into one.
Yeah. Good thing about California, man.
Oh, man. We have so much national forest and public land that you can literally just cruise out and find a place to camp. It's ours.
What I wish was mine is Jan's sweet truck.
It's a 2019 Ford Ranger. Has about 200 watts of solar in it and a fridge, and has everything that an RV has except for a toilet, but just on a smaller, simple scale.
And you drive us around day to day in LA.
Yep.
And then just roll out when you want.
It's my daily driver. Handles great. And then when I'm done with work, I can just bail and go camping. So the camper basically has only what I need. Think of it as backpacking with a car.
Yeah.
The fridge has a couple compartments. This is just a kitchen box, stove, utensils, and a bunch of stuff. This one has just dry food. Then when you get inside, there's a bed. The bed flips up, so you've got tons of room in here. This awning is phenomenal. If you want to pull that over.
That's cool.
Let me just pop that up.
Sorted.
So, home on wheels.
Yeah.
This is my vacation house.
Dude, it's so nice, man. Even with his nomad lifestyle, Jan faces the same big question as the rest of us. Do the internet and smartphones have to ruin everything? When you find the super special, beautiful spots, is that you busting out a map and like looking where it might be cool to go, or is it word of mouth and just getting to know people, the locals? And
if I see a dirt road, I just want to go down it. So a lot of it's just aimless rambling. It's a desire to just see something. Check that out. For some reason, it's more fulfilling than getting a recommendation from somebody. Or there's tons of apps and websites now, road trip apps, camping apps. they've proliferated. The knowledge is accessible on the internet, right? I used to fight the geotags, and I would get really pissed off. Like, why are you posting this place? It's gonna blow up, it's gonna get trashed. Now I've realized that you can't fight it. The internet has just shrunk the world. So we're not gonna stop it. We're not gonna stop people from going there. So I'm a lot more focused in conversation now with trying to set a good example. When you go, pick up your trash. When you're pooping out in the wilderness, don't leave your toilet paper on the top. You know, make sure you follow, good steps for leaving no trace.
As a thank you for this quick guide to pooping etiquette, we made Jan, Heron, and Lemmy some tacos. And we all took in the night sky and knocked back a couple of drinks. Take that, Apocalypse. The thing about good times and serenity in 2020 is that they're fleeting at best. After we split up from Jan and continued on our way, smoke started to envelop us. The plus side was that our RV no longer smelled like feet. The downside was breathing. My man David here suggested that we try and outflank the smoke by cutting through Yosemite. Without a reservation, we had to talk our way in.
Yes, no stopping, no getting out, and
Yeah, don't go in the valley.
yeah, no problem. We just wanted to get through.
It was a beautiful choice. Glad we got out of the smoke.
Whoa, okay.
But not quite as effective as we had hoped. Fast forward 4 hours or so, and we had managed to trade the smoky majesty of Yosemite for the smoky,
Look at it.
strip malls of the Central Valley.
We have made it sort of out of the smoke, all the way across Yosemite National Park and here to the gorgeous Central Valley of California. We're off to see a kind of surprising tech startup that is making some pretty strange machines to serve all the growers out in this region. And we're here in this near Fresno. This is California farm country, right?
We're just south of Fresno, a town called Kingsburg.
So we're right in the Central Valley of California, very, very large farming valley here. It's kind of considered the breadbasket of the world.
The Central Valley stretches out over about 20,000 square miles, and the farmers here produce about 1/4 of the food that Americans eat, including a whole lot of fruits and nuts. Tell me a little bit of the background of Gus. I know some of this is like a family business. The roots of this go back a ways. Tell me kind of like how we got to what's essentially like a startup, I guess.
Yeah, definitely. So the founder of our company is Dave Crinklaw, and he started the business back in 1982. He started with is basically with his dad was commercial spraying of trees and vineyards. Got to the point where our biggest challenge was labor, just the shortage of it, really. He was forced into innovating, and he had this idea for quite some time about doing a driverless sprayer, and it finally got to the point where he said, you know what, I either got to get out of this business or I'm going to innovate.
Organic or not, crops need to be sprayed, and this process has to take place a few times a year. This means hiring a lot of people to work long hours under serious pressure. And so, just like the tech bros to the north, Gus decided to solve all of its problems with robots. On this like labor point, you guys have set this up where you can have somebody in a truck and that one person can monitor, I think like 8 of these.
In order to operate Gus, you have one guy or girl that sits in a pickup and they monitor from a laptop computer. So that person is basically just watching all the vehicles on the screen. They can monitor up to 8 of them at a time while they're out there spraying in the orchard. And so that user interface really provides them with all the information they need to make sure that the machines are safe and that they're doing the correct job. So it tells them what speed they're driving, the engine RPM, the amount of gallonage per acre that they're applying at any given time. So if any one of the machines has an issue, it's going to send an alert to that laptop.
Much like a self-driving car, these beasts use GPS, LiDAR, and cameras to see and navigate the world around them. They also rely on pre-built maps of the orchards for extra guidance. Gus builds the machines right here and then takes them out for robot training on this orchard next door. It's here that the company learns if the machines will behave and do as their software and human masters command. So this is kind of like this is a test orchard where you guys put it through the paces and work on the technology?
Yeah, so this is our test orchard right here. It's right by our building, as you can see in the background. So every new machine, as it comes off the assembly line, it's put through a commissioning test right here. We test all the sensors on the machine, autonomous computer, all the safety systems, make sure it's doing what it's doing prior to when it's delivered to a customer.
So what's it doing now?
So right now he's doing a test spray. So he's just turning the water on to make sure that the system comes up to pressure, spraying water out of the nozzles just to make sure it's all functioning properly.
Okay. It's got like a crazy turbine at the back, or?
Yeah, so it's basically just a big fan.
Okay.
And that fan's driven off of the Cummins diesel motor, and it just basically creates a big airflow.
Gus is already selling these vehicles to brave modern farmers. And people the world over have taken notice of its machines. And have you just sold them in the Central Valley or like throughout the U.S. or even overseas, or where are they going?
Yeah, so right now the majority of our machines are here in California in the Central Valley. However, we do have machines and customers in Florida and the citrus industry over there, as well as Australia.
And I think you started selling them in like December of 2019?
Yeah, right? So we started taking orders early last year for the sprayers, and the first deliveries we made were in December of 2019.
Okay, so. And how much do they cost each?
So our retail price on these machines is $285,000.
So it's not a small investment, but I'm sure the regular sprayers aren't cheap
Yeah,
either.
I mean, we're honestly not too far away from conventional equipment on our price, and the main thing is that the return on investment is very, very quick due to all the labor savings and the increased efficiency. I mean, these machines, they just drive. But basically what we're doing, besides this machine, this is our first machine, we call it Orchard Gus. mainly designed for your nut trees, as well as citrus and fruit. In the future, we're working on a few other projects. We're going to do more machines. One of them is actually a vineyard sprayer. So vineyards are much tighter spacing, so the machine has to be physically smaller. And then we've got our eyes on doing a lot of other innovating.
That right there, friends, is a Central Valley farmer putting his whole fruit basket on the table. Gary's TED Talk can't be far off. And with that, it was time to get back in the RV and to confront what happens when three men are bested by their own failings and the forces of entropy. Next on Hello World, we cruise into the Mojave Desert in search of a lunar lander.
We have instruments that we are going to deliver to the South Pole of the Moon in December of 2022. Instruments that are trying to scan the surface of the moon.
And hang with a test pilot who walked away from this.
Meet Betty. She lives by herself, but for the last few months, she hasn't been alone.
LQ, tell me a joke.
Did you hear about the claustrophobic astronaut?
No.
Apparently, he just needed a little space.
Most technology isn't made for 93-year-olds. But this woman is making sure that this particular robot is.
I like you. Who are you?
She's researching the way we interact with machines. And if she has her way, robots will soon be a trusty companion for all of us.
My name is LQ. How can I help you?
As technology replaces old jobs, it's also creating new ones. I'm Aki Ito, and I'm here to show you the jobs of the future.
My name is Danielle Ishak, and I am a human-robot interaction researcher. It's really hard to intuitively design a robot meant for a consumer audience. You have to make sure that it's a robot that people want, people know how to use, and people value.
Danielle works for an Israeli startup called Intuition Robotics. Its U.S. office is here in downtown San Francisco.
Hello?
Hey Danielle, it's Aki.
Come on in.
The company is funded by a couple big names like Samsung and Toyota. Full disclosure, Bloomberg's venture capital arm is an investor too.
This is LEQ.
Can I take her out for a spin?
Please.
LEQ, tell me what you can do.
I am a proactive social robot designed for older adults. I can connect you to your family and friends, and even play music.
These features might remind you of the Amazon Echo, but you'd be missing the point if you compared her to a smart speaker. She's not meant to just be useful. She's meant to be a companion.
Why don't you take a break and have a drink?
And that's why she has a head that can nod and make other subtle gestures you might expect from a pet.
Through our research with older adults, we're finding that almost on a daily basis, we see that somebody tells her that they love her.
Really?
Or that they like her.
Like,
or that they miss
literally,
her.
I love you?
Mm-hmm. They'll also tell her, I'm depressed, or I'm lonely. They'll open up to her in a way that they might not necessarily open up to a human because they don't feel like they'll be judged.
LEQ isn't on sale yet. But a prototype is already in the homes of about a dozen early testers who live in the Bay Area.
LEQ, tell me what the weather is today.
Danielle's job is to figure out what's working and what's not.
Sorry, please rephrase your request.
And she does that by visiting each of her testers twice a month.
How important are these visits to your job?
They're critical. We're building a product for people who we are not. I'm not a senior, and how could you know how to design for somebody if you don't do research? Because otherwise, you would just be designing in the dark.
Jobs like Danielle's are just starting to emerge. Until recently, robots were mostly in factories, separated from humans. But now, they're finally getting cheap enough, small enough, and smart enough to be in our homes. This has created a whole new challenge of designing robots that people will actually want to interact with. And that's where Danielle comes in. Her research has helped shape every little facet of LEQ, from the way LEQ moves to the way she talks.
It's a very special job, and it can be really hard, and it can be really frustrating, but at the end of the day, it's incredibly rewarding. And I think the most rewarding part about it is when I see the joy on the users' faces, like that they saw their feedback turned into something real.
Today, we've driven east of San Francisco to go see one of Danielle's research participants.
LEQ, tell me something interesting.
Did you know that Ronald Reagan was a lifeguard in high school and saved 77 people's lives?
Now, see, this is where a conversation is. She should open up and I should say, no, I did not know that. I expect her to be able to continue a conversation for at least a couple of comments.
Yeah. And why is that?
Why?
Yeah.
Because that's companionship.
When Betty was around Danielle's age, she was working with some of history's very first computers.
When I was finishing up my master's degree, I was working at Harvard in the computer lab when they were building Mark IV. A large room-sized computer. But now, this artificial intelligence stuff is amazing. LEQ?
Yes?
Schedule a doctor's appointment.
No problem. I'm working on it.
When Danielle brought along the idea of working with robotics for the elderly, I said, are you kidding me? Will older people connect to a robot? And she said, I don't know, let's research and find out.
Danielle grew up here in this suburb of Atlanta. Her parents spent much of their childhoods in Israel and met in the US.
We as immigrants, we understood that we might need to work a little harder. In fact, I feel that rather than taken away from Danielle, it gave her so much more, because she understood the fact that you need to run after your dreams and work really hard, no matter what the challenges are.
School didn't come easily for Danielle.
I have dyslexia, and that very much affected my self-esteem academically.
The principal of the school did not recommend her to take advanced classes. She fought for it, and she got into it, and she did very well with them, too.
Danielle's first job out of grad school was at X, the secretive research facility founded by Google. It's known for dreaming up all kinds of wacky, far-flung ideas.
Can you tell us about the moonshots you worked on?
No, I can't tell you too much about the projects that I worked on. I can say that I was working on robotics.
She loved the job, but wanted to work on something that would reach real consumers sooner. So she left X after a year and joined Intuition Robotics. She's been working in the field for 4 years now, and it took her a while to find her footing in a male-dominated industry.
I've gone to different meetups where there'll be like a circle of men with their like zip-up jacket with their like company logo on it and a beer in their hand. And I'll come in with lipstick and nobody wants to talk to me. This is my closet.
So at first she did her best to fit in, wearing a pair of glasses she didn't need and toning down her style.
So what's the kind of thing you used to wear to a conference?
Stuff like this, blousey things that make you look like you're 40.
But that got old after a while.
And what's the kind of thing you wear now?
Now it's like I just enjoy being kind of expressive and playful in what I wear.
Before we wrap up for the day, Danielle has one more LEQ tester to visit. Joseph is 97. And he's had the robot in his home for 8 months.
How are you? I'm fine. How are you?
Good. How has Miss LEQ been?
She always tells me to take a drink of water at least 4 times a day.
So, we added a whole bunch of new facts to LEQ.
Did you know that a cup of chopped red bell pepper contains more vitamin C than an orange?
Okay. What did you think of that?
Certainly, the print was, I could see that quite clearly.
What about this?
Well, I can see that. LEQ, play music.
No problem. It will begin shortly.
By 2050, almost 500 million people are going to be 80 or older. And if current trends continue, more and more are going to be like Joseph and Betty, living alone.
LEQ, stop.
Today, both of them are doing okay. But some of Danielle's other participants have been struggling.
Is it kind of hard to leave them at the end of the day?
It is. Some of our testers are pretty advanced in the stages of depression through loneliness and isolation. And at times, I know that LEQ is cheering them up in their day, but I know that it's only part of the way. No source of artificial intelligence, robots, will ever be able to replace humans and human companionship or human care.
The key to Danielle's work is to embrace that very limitation of machines.
Robots should help humans do what they love, help humans interact with more humans, help humans in general. Not pull humans away from humans, not take humans' jobs and leave humans without purpose.
Whether it's in our workplaces or in our homes, robots are soon going to be everywhere. And it's up to Danielle to make sure this robot-filled future leaves us just a little better off.
So don't be afraid. And if you are afraid, come and join us, because I promise it's a friendly place.
Times are tough. Jobs are scarce. It's risky to be outside and around others. Seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy. Austin John Plays.
This is your full-time job now, right?
As of November of last year, yes. This was always just kind of like a side thing. Like, any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like I hit my first day that I broke $1,000 and I was like, this is actually going to be money.
How did the YouTube channel come to be?
When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one. And that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people.
What do you need to think about if you're building your YouTube channel?
1, you need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about. It holds a special place to them. And third is, it needs to be something that people are gonna seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. 1, which is the bulk of it, which is ad revenue. Whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ad at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country of the person who posts it, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising. So because of that, CPM went down. CPM stands for click per thousand. I'm using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, you know, if I post a video when there's no ads being spent, like January and February, that's the reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year, because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges. Or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you post it on Reddit and they say, shut up, and then an auto mod bans you. You have to go through that, because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
Huh. So make a channel about something that I'm passionate about. Oh, sweet. I guess I can make the channel about that.
Diversification, right? You have to have a massive Twitter following, you have to have a massive Instagram following, you have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform, but basically any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games, they're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game. The best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny, charismatic, whatever it is on that side.
Oh, no.
You know, it becomes more of a show where they talk about other things outside of the gaming world, and gaming becomes really just a backdrop and an excuse to engage with that audience.
There were those weird, like, Ronald McDonald, like, straight to VHS movies. You remember those?
I'm personable, I'm chatty. I would kind of, you know, when boring things were happening in the game, I would ramble on about, you know, movies I'd watched or books I'd read and, you know, or conversations I'd had and stuff like that. And so I think being personable was a big part of that.
It's not just getting on and playing games. It's getting on and being an entertainer. You are putting on a show.
All right, now let me go ahead and grab the samurai sword that every gym has. Okay, he's dead.
To have a larger audience and to have that audience, I think, stay with you, you have to bring something extra. You know, you have to find your niche. You have to find what works and what connects with the audience and what makes them laugh and what makes them keep coming back.
You gotta make it a little more exciting, all right? Throw in a hanging bishop. Have everybody in suspense for a moment.
I think the real most important thing is to just get used to being on camera. Like in any sort of performance thing, is get used to talking on camera. You know, my first few videos were terrible, but because I sat down and did it for 6 to 8 hours a day, I just got used to talking and I got over that uncomfortable hump.
If you go into Twitch purely with the expectation that you're going to make money, make a job out of it, have all this growth, and it's going to be great, you're probably going to burn out prior to getting to that point because there's very little payoff for a long time, right? Like multiple years generally before you really start to see a payoff. And so, you know, those first few times you're streaming, nobody is there. One person shows up every 30 minutes, says hi, maybe, and leaves, right? Like, it's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. You have to love just the game that you're playing, all of that stuff, because it takes a while. And I think a majority of people burn out prior to getting to the, like, profitable point of it.
And there you have it. My very own YouTube, Twitch, Discord, and streaming channels all ready to go live. It's a veritable social media ecosystem just on the verge of thriving. So, don't forget to smash like and subscribe, and visit my Patreon for perks. Also, go to my merch page. And one last thing, stay cool, my friends.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
I gotta tell you, Matt Miller, if I had an auction voice, I'd be like, 4,400, do I hear 4,500? Do I hear 4,600? Yeah.
It's pretty cool, huh, that we can continue to march higher?
Look at this. In like the last, 10 minutes or so, I'm looking at my chart here at intraday. It is just moving up here.
It's like capitulation to the upside. Maybe there is some short covering involved as well.
Have we found a bottom?
Well, we had the bottom in October. The question
Doesn't
is...
mean we can't go back there.
That's true. It's definitely possible.
There's
but
some negativity out there. We're going to talk to Jess Menton about this because there's a lot of folks...
It seems... I don't know. Here's the thing. There is an argument that everyone who was to be won over has been won over, right? That the crowd is all here now, so where's the incremental buy-in?
Jump on board?
Well, everyone is on board.
Yeah, that's true. I guess so. But wait. What about all the cash on the
sidelines? There's so much cash on the sidelines. MMFA
that
index.
Means everybody is not on board. All right.
True. There's a lot of cash in money markets. Right now, $5.456 trillion.
There's a lot of cash on the sidelines.
Yeah.
All right. Having said that, folks, it is Carol Masser along with Matt Miller. Tim, is on leave, and welcome to the Thursday edition of Bloomberg Business Week. We are going to talk about the U.S. economy. We've got some data points holding up, but we're seeing losing some steam. We're also going to talk about, Matt, crypto getting its moment of clarity, and then we've got a takeover of Business Week.
I've been saying for a long time that there is clarity in crypto regulation.
Because there's none?
Because they will stamp you out if you're a crypto business.
Oh, you mean from the regulator's perspective? There's some clarity. We're also going to get to one of our most read stories about O'Day Asset Management. Man, it's just come undone. The end game is here.
Yeah, Crispin O'Day obviously is out, and the company is shutting its doors, and they're trying to get somebody else to hold its remaining assets.
We're also going to talk about getting a good night's sleep. It's very important. A crucial link potentially with dementia. And then we're going to talk to the co-founders of Tiny Organics. Matt knows this company intimately.
Tiny Organics have helped feed my tiny baby at home.
All right, countdown to the close starts now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. About 60 minutes left to go here in the trading session. Romaine Bostic joined right now by Scarlett Fu, as well as our colleagues Carol Masser and Matt Miller. Welcome to our audiences across Bloomberg Television, Radio Originals, and those folks streaming on YouTube. Carol Masser, you're already smiling. Maybe that's because the S&P is up 1.5% on the day and you just got off the phone with your broker.
Yeah. No, and no. But I did say to Matt at the top of our broadcast that I kind of wish I had an auction voice because it's like, do I have 4,400? Do I have 4,400? I can't do it. Anyway, we continue to move higher. Having said that, I'm going to go to a place where I hope cue eye rolls. We're going to get it from Matt, maybe even Romaine, but not from Scarlett, because I know she's on board with me on
Is
this.
it the dragons?
The Chinese names that trade in the United States. Let's bring it up for everybody, because, man, they're on a tear, and they're outperforming the trade that we're seeing in the U.S. We did see the NASDAQ Golden Dragon China Index. I think it's probably up 19-20% here in the month of June alone. It's really about more stimulus, easing tensions between the U.S. We saw China's central bank lowering its main policy rate. We got that overnight. Earlier this week, they also lowered a one-week interest rate, injecting more money into the banking system. So the Golden Dragon up 2%. Take a look at JD.com, up 3.5%. PDD is up about 2.8%. Alibaba up about 3%. There's a reason we talk about this.
True. Some people own those things.
Watch it.
Not me. Let's take a look at what's going on in, don't fight the Fed is a mantra that has been in this market longer than I have, but it doesn't seem to be sticking. Everybody thinks that the Fed is kind of bluffing in terms of the dot plot. Right now, the Fed forecast is for a terminal rate of 5.75, and the market is pricing in far less. Still, after Jay Powell came out yesterday and said basically, don't bet on any cuts. That's not happening for a couple of years, which I think is interesting.
Well, at least for right now, a market has made its peace with where inflation is and where the rates are, at least for the day, 4,400 and change right now on the S&P 500, up about 1.4%, a six-day run right now for the S&P 500, a six-day run for the NASDAQ composite, which is up about 1.4% here on the day. The Dow Jones Industrial Average also up 1.4%. The Russell getting in on the action as well, up by about 0.7%.
And looking at the sector groups, it's not surprising that all 11 industry groups are higher on the day, with Real Estate Investment Trust, the laggard here. They were in the red for a bit, but as the indexes make this push in the last, let's say 40 minutes of trading, we've seen them flip into the green as well. So communication services, industrials, and tech lead the way, though notably chip-related companies are still red, a little bit, but still in the red. Consumer discretionary and staples, also some of the laggards, but here we're talking relatively because they're still up by at least 1%.
A big part of the reason you're seeing a lot of green on the screen is, well, all your favorites moving higher on the day. Apple, 186.16, a percent higher than where it closed yesterday. That's going to be a fresh record high, should it close at that level. Lennar, up about 5% on the day. That's going to be a fresh record high, should it hold on to these levels. And then when you talk about some of the optimism coming back into this market, how about an IPO? We haven't had too many IPOs this year. In fact, this is going to be the slowest year for IPO, at least as of where we stand right now, at least going back to the financial crisis. Cava priced last night, it priced above its range. This is the kind of the fast casual Mediterranean restaurant chain here. Shares up about 98% off of that pricing right now at 43.63. And then take a look at Kroger. Those shares down 3%, and this gets to the conundrum of where this market is and what it's trying to price in. Not necessarily good commentary out of Kroger as you continue to see some stresses, particularly at the lower level of the income spectrum. Something to keep an eye on. And Matt, you were just talking about some of the pricing in the bond market. Flip up the board real quickly here and just take a look at the inversion that we continue to see on one of the key parts of the yield curves, the 210s, but really you can cherry pick any part of the yield curve and you're going to see something similar. I thought it's interesting, not just that we're in negative territory, but this is the longest stretch that we've seen the yield curve in inversion going back to 2000, and more importantly, the longest stretch that we've seen it in negative territory without a recession.
All right, so on the back of that, right, we did get some data points today. Retail, we got some trade data, we got some factory data. U.S. economy, yep, still holding up, but we're starting to see some softness, all right? So on that, Richard Clarida, former Fed Vice Chairman, earlier on Bloomberg, talking specifically about data points. Matt and I have had Matt's made some fun. We'll talk about that in a moment. But looking at data points and now saying that the Fed, according to Clarida, that now the Fed is really data dependent. Check it out, everybody.
The Fed has inflation coming down more slowly than a lot of folks, and the Fed also has a smaller rise in unemployment than a lot of people expect. And so I do think that if the data is closer to market expectations versus Fed expectations, that they could be done in July. So I really think for the first time in a while, they really are data dependent.
Data dependent. All right. Former Fed Vice Chair Rich Clarida, of course, Global Economic Advisor over at
he says this is the first
PIMCO.
time that they're data dependent. Have they not been data dependent for a year and a half? By the way, Mohammed Al-Arian was saying just a couple of weeks ago that if they really were data dependent, they would be raising right now. And Clarida's saying finally they're data dependent, which is why they're holding. It just It always bothers me when the two smartest people in the room completely disagree on something.
I have to admit that comment from Richard Clarida also confused me, that they were finally data dependent, which means up until now they had already made up their mind and were just waiting to cherry pick data. I didn't quite totally understand it.
Yeah, I honestly, I think this is one of those things where maybe he misspoke a little bit, but it gets to the broader issue here of what they've been doing over the last year and a half. And really, I think maybe what they were doing leading up to that here. Is there a case to be made that they weren't?
I think there were a lot of people misspeaking lately. Powell yesterday said they won't cut for a couple of years. He also said the housing market has found a bottom. What? What is he talking about?
I think bottom line, everyone is confused by the economy. We've been looking at an expected slowdown for so long. There's been talk about a recession. It hasn't come forward yet. And now in the debate about whether there's going to be a soft landing or hard landing, maybe there are people saying whatever the case is, people are making plans for the uncertainty and just kind of trying to manage through it.
Yeah, I mean, look at what's going on with the 2s and 10s right now in terms of what the markets are telling us. But what's interesting is I think the Fed is data dependent. I think we're very well managed. The Fed speakers are going to start all over again as we count down now to the July meeting.
Yeah, and I mean, I think we get a little too caught up. I do think the communication, though, was consistent, right? Now, whether that was based on data or not, it'll be years before we finally get to see the detailed minutes and know exactly what they were talking about here. But I don't think anyone can look at what came out of Jay Powell's mouth and say that it hasn't been consistent over the last 15, 16 months.
But it is kind of interesting, right? Because if they are data dependent, right? If you look at the rates, even though we're seeing softness, if we look at where things are coming in, you would kind of be able to easily make the case for the Fed continuing to raise rates.
Of course.
What's going on over with Matt? He's a little grumpy today.
No, I'm feeling good. I'm in a great mood.
Okay.
Yeah. I mean, look, Romaine, we were talking about this yesterday. Inflation is coming down. It's on a good path. The question is, are they going to stick to it? Are they going to avoid the mistakes of Arthur Burns? And are they going to drive it down to 2% and hold it there?
Okay.
They hope so. All right.
Hope so.
Let's see. Maybe he won't be so cranky next time.
Maybe. Just, when's that wine segment, Carol? Is that coming up? Just
I'll work on
give him
them.
a couple glasses.
I got 40 minutes. All right, guys. We'll be back in about 43 minutes or so, 53 minutes. We're going to count you down at the close.
Wow, Carol's already been drinking.
Hey, nothing but water. Nothing but
She's
water.
so excited it's going to be 43 minutes. That's how it feels.
Thank you, Scarlett. All right, join us at 4 p.m. Wall Street time, radio, TV, YouTube, and of course, Bloomberg Originals. We'll count you down to the close on this Thursday. Beyond the Bell at 4 p.m. My friend?
Exactly. It was a show.
That hurts.
Do you
me.
remember the show? Jennifer Aniston? No.
Oh my God, that
I don't think they know.
All right. All right, well, the U.S. economy is holding up but losing steam. We just talked about that. We saw an advance in retail sales last month, exceeded nearly every estimate and in a lot of categories, Matt. So it shows the consumer is still outspending.
Is still outspending. Still going to pay way too much to buy a car.
Tell me about that. We're still waiting on that. All right, we want to get a look at some of the data points that have come out and what it's telling us about the economy one day after we got that Fed decision.
And the markets.
And what it means for equity markets in terms of valuation. So with us right now, we're going to start with Bloomberg Intelligence Chief Equity Strategist Gina Martin-Adams. She's on Zoom in New Jersey. Gina, so good to have you here with us. Tell us a little bit about, what do you make? S&P 4,400, and we continue to move higher. Significant?
Yes. I think it is significant, Carol, mostly because it's actually being confirmed by breadth improvement in the S&P 500. Remember, it was just a few weeks ago that many naysayers to the S&P 500 gains to date have been talking about the narrowness of the gains as a risk to markets. Well, now we have 60% of stocks in the index trading above their 200-day moving average. You've got breakouts in 2 of the 3 leading industries on the index. So home builders and semiconductor stocks are breaking out to new highs. Not just higher levels, but new highs relative to their former 2021 peaks. So there's just not a lot to complain about. Cyclicals are outperforming defensives. Even small caps are participating here. So it is a very broad-based rally as the market appears to be moving past the earnings recession that emerged in 2022 and looking forward to some form of recovery in the earnings stream.
I wonder how much of this is kind of capitulation to the upside, Gina. I looked at a chart that Dan Curtis gave me last week showing record shorts in S&P 500 futures. So there were a lot of people hedging this rally, and is everybody just getting on board now? Okay, we're, off to the moon. Here we go. Let's get on.
I think there is something to that theory. I mean, it certainly throughout the spring, the range trade was really embedded in psychology, where investors were saying, okay, we've entered this range trade. There's no way we're breaking out of the range with economic recession becoming imminent. And once we broke through the range in May, we started to see stocks really take off. So I do think that investors jumped on board once we broke through the top of the range trade that really had been in place since the end of January. And that created some degree of complacency in the investor community. So when we broke out of the range, investors had to jump on board, cover their shorts, but also start to participate a little bit in the long side of the rally. I think a couple of things really lined up here, right? Employment is not nearly as bad as anyone had anticipated it would be. By this time, if we really are falling into recession, you would expect employment to start to confirm some of the weakness. And then inflation, frankly, has been very, very benign. And that downdraft in inflation is extremely consequential, especially for stocks, because the earnings recession that we had last year was largely because of inflationary conditions. We had this big inflation breakout, creating earnings distress and a major earnings weakness that created a big drag on prices. Now we're having inflation ease off, and that's creating some margin stability, even margin forecast improvements. And that's come as a bit of a surprise to the consensus expectation, which was for, inflation might ease off, but really recession is the risk in 2023.
All right, you opened the door really perfectly by mentioning labor data and inflation data for our Michael McKee, international economics and policy correspondent, Bloomberg News, still in D.C. after the Fed decision, which he was there and talking to Jay Powell. So, Mike, things lining up, the labor market, inflation, like Gina said?
It seems like it. What we seem to be getting at this point is an economy that is doing what the Fed wants. It is slowing down at a reasonable pace. It is not falling off a cliff. And they do seem to be making some progress against inflation. Now, they took out some insurance yesterday against inflation starting to go back the other way or being really sticky. But at this point, it doesn't look like we necessarily need to have a lot more rate tightness to get inflation to keep coming down. And if it does, then they don't have to use those 50 basis points they put in their pocket.
Is that the insurance, you mean, the dot plot? I mean, the hawkish positioning, Jay Powell saying there's not going to be any cuts for a couple of years?
Yeah, I think this was driven in part by what happened in Canada and Australia. When those reserve banks took the interest rate increases off the table, the possibility of it, and then they had to come back and raise rates because inflation took off again, that was a real shock for the market and a real problem for them in terms of financial stability. So the Fed didn't want to say there's no more rate cuts, no more rate increases coming. And I think they felt if they said even that they're just pausing or skipping, that the markets would price in rate cuts. So what they managed to do with yesterday's move is to tell the markets there are not going to be any rate cuts this year, but they put them into 2024. So if you're an equity investor and you're discounting what's going to happen 6 months ahead, you are probably right to start thinking things are going to be okay, and that may be why we're getting the reaction we are getting there. But the Fed doesn't have them putting in the rate cuts this year.
So, Gina, there's a lot of ways to look at the markets, fundamentally, technically. I'm looking at RSI, Relative Strength Index. I like it. We have the S&P 500 bump, actually gone through an oversold level, very much easily so, it seems like, if you look at the chart. But we've also been there before if you go back a few months. And then we just kind of pull back a little bit, and then you see stocks, the S&P specifically, resume its move to the upside. How do you factor something like that in?
Yeah, we actually wrote about this week for Chartbook, so you'll see more on this later tonight when our Chartbook goes out. But RSI momentum as well as breadth have been confirming the rally in stocks, but RSI, 14-day RSI does look to be getting a little bit overbought in the short run. It's hit levels or extremes last recorded all the way back in the latter part of 2021. So it would suggest that the rally is very overbought at this point in time, and we may be due for a little bit of momentum slowdown. Now, this does not mean anything for the longer term. As long as breadth is continuing to improve, participation is relatively strong. It probably just means a little bit of a cool down, and then we're due for a bit of another consolidation as we head toward the next earnings season. That said, you can get periods of time where RSI can stay very overbought for a very long period of time. So it's something to watch, certainly as a short-term timing indicator, and a lot of folks are starting to point to this as a signal that we may be getting a bit overbought in the short run. But I would not over-attribute the signal as something more meaningful or ominous for the longer term.
How can I get the chart book? Is that BI space stocks and?
Yes. Thank you, Matt. You
Yes.
can go to BI space STOX go, or you can just ping me on the terminal. But we send it out every Thursday night at midnight, so you can have it in your inbox on Friday morning.
RTMA.
Nice.
Gina Martin Adams. Hey, Matt, forgive me. Michael.
Wait, I got to ask Michael.
What?
Yesterday, Mike and a bunch of Fed journalists who are deadheads were going to ask Jay Powell about the show. He had, at least we see a picture of someone who very much looks like Jay Powell from the Virginia show. Did you ask him about the dead? Did anybody slip dead lyrics into a question?
Do we have Mike?
Is Mike
Did we
still
lose
there?
Mike?
I'm still here.
Wait.
Sorry.
Okay, wait. So go ahead, Mike.
We did fail. We did not ask. Didn't seem to be the right mood for it. However, I can confirm that he was at that show, and there's an interesting backstory. He has been a fan of the Dead since 1972. Saw his first show at RFK Stadium, and his sister went to high school with Oteil Burbridge, who, as you know, is the bass player for Dead & Company now. And she apparently gave Oteil his first Dead records. So he got into the Dead because of Jay Powell's sister. How's that for a story?
I have goosebumps. How's that?
Okay, I love that you do, but I want to know why you think Powell wasn't in the mood. 15 seconds.
He seemed grumpy, yeah.
Was he grumpy?
No, I think he had a message to deliver, and he was trying to stay on message because it was a little tricky.
Yeah.
And you saw at one point where he said, we made a skip, and he said, no, I shouldn't say skip.
All right.
He didn't want to lead people on.
I got it. I know, Skip. I didn't mean for it to come out. Don't say it. Gina Martin Adams, Bloomberg Intelligence, Michael McKee of Bloomberg News. Thank you both so much. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:21 on Wall Street. We do check markets all day long at Bloomberg. The Dow, the S&P, NASDAQ 100 index, all pushing higher. We are holding close to session highs, right to the numbers. Fast-moving markets on this post-Fed day. S&P right now up 59. That is a gain of 1.4%. The S&P 500 index right now at 4,431. We've got the Dow up 439 points. That is a gain of just about 1.3%. NASDAQ Composite Index up 178 points now, an advance of 1.3%, while the NASDAQ 100 Index, full of big tech names, up by 213 points, up now by just about 1.4%. The stock rally driven by the exuberance surrounding AI is widening beyond the tech industry, defying naysayers and raising concern about an overbought market. 10-year yield 3.72%, with the 2-year 4.63%. Spot gold up $15 the ounce now to $19.58. That is a gain of about 0.8%. And we have got West Texas Intermediate crude surging 3.4%, $70.60 a barrel. Central banks are sounding hawkish, but should investors believe them? Ann Berry is managing partner at Threadneedle Ventures.
The Fed tends to have, a slightly more backward-looking or more recent data bias, and I think that's where we're starting to see a disconnect. There are some signs, for example, in auto loan defaults, that the consumer's starting to feel the pain. We're seeing a lot of forward-looking pain when it comes to commercial loans, for example. So I think that's where we're seeing the forward-looking perspective of the market and the more recency bias of the Fed beginning to part ways.
And you can hear more of that conversation on the Bloomberg Surveillance podcast. You can download it wherever you get your podcasts. Delta Airlines board has voted to restart the company's quarterly dividend. Airline shares flying higher today. Case in point, Delta up now by 1.5%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
You buying this AI craze, Charlie?
No, I'm not. And I'll tell you why. I've seen so many market cycles, so many things that send stocks higher for reasons like this. Right now, yes, stocks are moving higher, but will it stick? We'll find out.
Yeah, we certainly will. All right, Charlie Pellet, thank you so much. Our thanks to Charlie. We'd also like to welcome in our Boston audience today, joining us on Bloomberg 106.1. Welcome them. And it's great to have them here. And they're going to be with us, we hope, fingers crossed, join us 3 to 6 p.m. weekday.
I wonder if the stereotypical Boston listener is more skeptical than others.
About crypto.
I feel like
about
people
AI?
in Boston are just generally more skeptical.
Because they're wicked smart.
And AI, exactly. The more I think about it, the more I read about it, it just seems like great marketing jargon for software.
Okay. Maybe. We're going to talk about this later on.
Yeah.
We are, because it's a tech takeover of Business Week, so we're going to get into all things AI and Microsoft, the big standout there. Hey, speaking of stories that are on our radar, this is among the most read. We have 2 crypto lenders with links to South Korea halting withdrawals in quick succession. So it's just a reminder that there's still a lot of risks and a lot of clampdowns when it comes to crypto. So on that, in the new issue of Bloomberg Business Week, Bloomberg News digital currencies and venture capital reporter Hannah Miller writing about no relationship to Matt Miller, right?
No relationship that I know of. I mean, it is, I believe, the second most common name in America.
All right. Well, Hannah's writing about how crypto is getting its moment of clarity, but not the one that it wanted. It's a great story. She joins us on Zoom in our San Francisco bureau. Hannah, I don't know. Have you done like, a genetic testing here to find out, what is it, Ancestry.com?
Ancestry.com. I'm on there. We would have been notified.
Yeah, I'm on there too, so no notification.
All right. Well, one industry that's gotten a lot of notifications, if you will, is crypto. So talk to us about your story, because I think they were looking for recognition, as you say, a moment of clarity. They didn't get exactly what they wanted, right?
Yeah, for years, the crypto industry has just been clamoring for greater regulatory clarity, and they wanted answers. They've wanted rules. They wanted guidelines. They said that they're working with regulators and that to them, there weren't clear processes in place. Well, now they've gotten their answer, and it's not a good one. The SEC is hammering down on crypto. These lawsuits against Binance and Coinbase show that the SEC thinks most of the tokens on these platforms are unregistered securities.
Yeah, so
are they right?
Well, that's an argument that that's a debate that we could have, right, Hannah? Because I think in a lot of cases, they seem more like commodities than securities. And, Matt Levine always cites the Howey test, and it's kind of a fun debate, but it doesn't matter. As long as Gary Gensler and the SEC say they're securities, they're going to use their power to shut down any businesses that are dealing in them without a license.
Yeah, that's correct. I mean, we've seen a lot of, different regulators jockeying for power here. The SEC and the CFTC, have claimed jurisdiction over crypto, but, the actions taken by the SEC show that, they're serious about this, that they want to crack down on crypto, and that's really put the entire industry on unsteady ground in the U.S.
So what does it mean? I mean, I've seen a lot of stories, yours included, like we are thinking about what it means for the U.S. crypto industry, because outside the United States, right, they're moving ahead.
That's true, yeah. I mean, we've seen, crypto hubs pop up in places like Singapore. Hong Kong is actually having a warmer reception to crypto. The UK is a big market that people are eyeing for Coinbase. That's the largest international market that they want to expand into. And also, in Europe, we've seen legislation passed there that the crypto industry sees as more welcoming to the industry versus the enforcement taken by the SEC.
We did have a great story, or I guess a positive story for crypto across the wire earlier today. According to CoinDesk, BlackRock is close to filing an application for a Bitcoin ETF, and they would use Coinbase as custodian. What do you think about this, Hannah? I mean, other people have tried and failed.
Yeah, so I mean, institutional investors, that is the key area for the crypto industry. They still want institutional approval, and they feel like that could maybe help carry them through and keep them, on more even footing in the U.S. So yeah, this news about BlackRock, that's a welcome development both for the industry and for Coinbase. This is a company that is publicly traded in the U.S., has seen its stock go up and down. So welcome developments like this are I'm sure, a boost to morale there.
It's funny, Carol, because everybody's pushing so hard for a Bitcoin ETF. As Hannah says, the thought being that it would kind of legitimize the asset class for investors. But there are already a number of crypto ETFs, and they've done incredibly well this year, except for the fact that nobody has any money invested in them. I mean, we're talking single-digit millions.
So how are they doing well then?
Well, the prices have gone up, right?
So
but there's no flows.
Yeah. So there's nothing into it.
Yeah.
Well, I do wonder too, Hannah. Go back to, you say institutional investors are clamoring for them. I mean, are pension funds give me some color on that.
Yeah, I think there's still, hesitance among pension funds, but we've seen players like BlackRock step in, that they still spy opportunity in this space. And, that's helped crypto enthusiasts, maintain a bullish attitude towards digital assets at large. So it'll be interesting to see if more, institutional players come out about crypto, if they're willing to, publicly raise the flag that they're still interested in this space.
One thing I want to ask you, with the lawsuits that we've seen by the SEC against Coinbase and Binance, they, as you report, could drag on for years. And I do wonder, you cite a case against Ripple that is still ongoing. That was back in 2020. Is it ever going to end? So I do wonder, is that good for for crypto players? Is that bad? How do we see that?
Oh, many of the people I've been talking to in the industry have, taken it as a good thing that these lawsuits could drag on, that maybe something will change, something will shift during this time, that they'll actually, get a better outcome than just the SEC winning these cases. So people have really clung to that as a sign of hope. And, they're trying to make a game plan here. They're, thinking about changing up their investment strategies. I've talked to a lot of VCs who are pulling back from token purchases as a form of investment, that they're just sticking to equity because there is this uncertainty around tokens. So it'll be interesting to see how all this plays out, how people, pass the years here.
One problem with these lawsuits is that you can really start to lose market share, right? An analyst, Dan Dolev from Mizuho, wrote today that Coinbase is starting to lose market share in crypto trading to Robinhood.
Yeah, no, that's correct. I mean, the lawsuit is a big drawback for Coinbase. And, people are going to maybe turn to, a more familiar name like Robinhood or, be willing to jump ship from Coinbase. So we'll see what happens, but that wasn't totally shocking to me.
I mean, go back to where we started. Are we still figuring out exactly what cryptocurrencies are? Are they a commodity? Are they a collectible? Are they a currency? Are they a security?
Yeah, I think we're still trying to figure that out. I've seen a lot of talk about pivoting from money crypto to tech crypto. So pulling away from like the financial aspects of crypto and looking at how blockchain technology can, provide use cases here. You hear talk about Web3, which is this decentralized version of the internet based on blockchain. So I think people have kind of tried to pull away from the financial scams and scandals that have just been continuing to rock the industry.
If she was a member of your family, she'd be a huge asset.
I agree.
I'm just going to say it. We're just going to put that out there, Hannah. That was incredible. Great story. Really, so timely. Hannah Miller, thank you. She is our Bloomberg News digital currencies and venture capital reporter, Hannah Miller. Just a great reporter. So I'm just having fun.
She's the host of the Sam Bankman-Fried podcast.
She is. Oh my gosh. Why didn't we talk about that?
Yeah.
All right. Anybody, download it, find it. It tells the story.
Yeah. It's very good.
Because it's still going on.
Yes.
It's pretty
I don't want to
amazing,
give out
right?
any spoilers.
Okay.
Well, the whole case is still going on as well, right?
Poor Hannah. She's looking out like, who are these two idiots? I mean, oh my God. Hannah Miller, thank you. All right, everybody. You are listening and watching Bloomberg Business Week. Let's get a check on world and national news. Nancy Lyon's going to save us. She's in our 99.1 newsroom in D.C. Help us, Nance.
Okay, I'll give you some news here. The U.S. is downplaying any expectations Secretary of State Antony Blinken will reach any breakthroughs during his upcoming trip to China. Washington and Beijing continue to square off over U.S. restrictions on chip tech sales, Taiwan, China's claims in the South China Sea, human rights, and Russia's war in Ukraine. Even their jets and ships keep having close encounters. Well, one of Blinken's predecessors, former Secretary of State Henry Kissinger, is worried about where things are heading between the two countries.
Well, on the current trajectory of relations, I think some military conflict is probable. But I also think the current trajectory of relations must be altered.
Former Secretary of State Kissinger spoke with Bloomberg editor-in-chief John Micklethwaite. Watch the full interview Friday night at 7 Wall Street time on Bloomberg Television. Well, the U.S. and Iran have been engaging in some quiet diplomacy.
Sources tell Bloomberg News negotiations have been held in Oman and on the sidelines of the United Nations in recent months. They say they've led to an initial agreement for Iran to free U.S. prisoners while the U.S. frees up payments owed to Tehran that had been frozen by sanctions. One source says diplomats are also pushing Iran to limit nuclear activity in exchange for allowances to ship more oil. In Washington, I'm Nathan Hager, Bloomberg Radio.
President Biden is claiming another victory in his administration's battle against surprise fees often hidden from consumers. He's negotiated an agreement with the nation's largest online ticket brokers, Ticketmaster and Live Nation, for them to disclose upfront all fees being charged in ticket prices. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:40 on Wall Street. We do check markets all day long at Bloomberg. The Dow, the S&P, NASDAQ 100 index, all pushing higher on a post-Fed rally. Let's head right over to the First Word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. That's right. U.S. stocks with an aggressive bid today, with the Dow currently up 431 points. S&P's gained 55, and NASDAQ is up by 1.3%. The U.S. 10-year yield at 3.72%. Gold is higher by 15. Oil also pushing higher, and Bitcoin is climbing by 2%. Of the main 11 S&P sectors, all are trading in the green, led by telecom and the industrials. And leaders to the upside in the Dow, Microsoft and Amgen. Modest losses in Nike. After earnings, Lennar traded to a record. Kroger fell 3%. And regarding IPOs, Kava opened at 42, was priced at 22. In the AI space, C3 AI rose 9%, while chipmaker NVIDIA hit a new record high. In other news, the Wall Street Journal reported that the Fed and the SEC are probing Goldman Sachs' role in SVB's final days. And wrapping things up, Adobe reports after the bell. Live from the First Breaking News Desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney. And to hear live breaking news over your Bloomberg, type Squawk, S-Q-U-A, on your Bloomberg terminal. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, let's get to it. We've got just about 17 and a half minutes left in today's session, and we've got a stock rally that it's not just mad about artificial intelligence.
No, it seems to be
Can you
about
put the snacks
rates.
aside?
Sorry, I have so many cups of snacks in front of my microphone on button that I sometimes...
You're like having a toddler around. It's like, I'm hungry.
I
Give me
just
some
need food.
Cheerios.
I'm a growing boy.
You are.
Carol.
Yeah.
So yeah, no, there seem to be a lot more drivers of the rally, and oddly, the Fed is part of that, even though the dot plot suggests they're going to raise rates 2 more times.
Right. No rate cuts, folks, this year. All right, so let's see what our guest has to say. Brian Railing is with us. He's head of global fixed income strategy at Wells Fargo Investment Institute, based in St. Louis, here in our Bloomberg Interactive Broker Studio at Bloomberg headquarters in New York City. Brian, it is good to have you here with us. Good to see the market spreading out, breadth in terms of gains. I think Gina Martin Adams, did she say 60 stocks in the S&P 500? Hitting above 200-day moving averages? You weren't listening because you were getting snacks. Let's go to Brian. So what do you make, though? We are widening out in terms of breadth.
Yeah, I mean, I think, quite frankly, the stock market, I'm a fixed income guy, but the stock market to me seems to be, it's kind of having a summer fling, quite frankly. Bad news is good news is good news. Any type of news is good news. It just wants to go up. But I think if you look under the surface, you look at what the Fed's saying, I don't know how long it's going to last. Maybe it can last through the summer, but I don't think it's sustainable.
I like we get the bond market take on the stock market.
Well,
this is awesome.
Well, it's like you guys compete with each other, right? Like when, bonds are yielding like they have, right? They're looking pretty attractive without maybe the risk elements.
Exactly. Very attractive without the risk. But also you look at what the bond market's saying. The yield curve is still inverted, and the inversion is...
Yeah, but inversion, smursion. How many times has it happened?
Every time the yield curve inverts like this, we have a recession.
No, I thought it's like you have to have a recession, you have to have an inverted yield curve. But every time it inverts, doesn't necessarily.
Almost always. And this is a lot, right?
Okay.
This is big. We're almost back to just look at 2
But it could be a touch and go recession, couldn't it?
Well, I mean, I don't think so. But I think that is the Goldilocks scenario that the market, and again, good news is good news, bad news is good news. I mean, I don't know how you could look at that FOMC statement and the press conference yesterday and come away doing high fives like it seems like the equity market's doing.
Well, we're still trying to figure it out, right?
Yeah, well, I mean, the dot plot suggests they're going to hike 2 more times. And before yesterday, the argument was definitely 1 more hike, and that was it. Plus, we were still pricing in cuts. this year.
Now we're
and
not.
yesterday, Powell, I don't know if he misspoke or if he's just trying to drive a point home, but he said, you're talking about a couple of years, folks, before we cut.
Absolutely. I mean, this ends in one of two ways, in my opinion. Either the Fed has to continue to hike to bring inflation under control and keep rates high. I don't think that's a great outcome for the stock market. Or if the market is right, because the market is still, the market's not pricing in these additional hikes. The market, if you look out further.
You're talking the bond market or the equity market?
Well, both.
Okay.
Both. And if you look out, you start to see in the futures, you start to see some cuts next year, et cetera, right? Which, of course, the Fed said they're not doing. So either, that's scenario one, or scenario two, something breaks. And that's how you get the Fed to start cutting rates. And I don't know how
Which is not
that's
great news.
Right. I
though,
mean,
right?
Yeah, exactly.
If we
So,
get more banks failing, and it moves beyond regional to Wall Street, then you're in real trouble.
Exactly. So that's why I think we're kind of in what I'll call a summer fling.
What are the flows that you're seeing?
Well, you're seeing.
So are a lot of investors coming up and saying, Brian, I want more exposure to the fixed income side?
We had a lot of that earlier in the year. You're seeing much less. Obviously, you're seeing the bearish sentiment decrease. People, I think, are kind of tired of hearing about recession and bearish, and so it looks like the AI started it, and it looks like it's just back to buying equities for now. But again, I'm a bond guy, but
no, I know.
You've seen earnings start to come down, right? I mean, I think they've been falling a little bit, kind of. I don't want to call it earnings
Gina Martin
recession.
Adams, our equity analyst, just talked about margin stabilization and improvement. And we are talking about, you look at some of the inflationary numbers, right? Some of the material costs are coming down for companies, and that's a good thing.
Okay, but
you don't buy it.
I mean, I just don't see how it's sustainable. If inflation is going to come down, if it's sustainable, then inflation is going to stay elevated, and then the Fed has to go much harder than the markets think.
Can I ask you, yesterday we were talking about the Ken Griffin story. He said he's embracing private credit, for example, much
high
more.
High yield, I thought it was, right?
And high yield as well, as we get closer to a recession. Does that make sense? If you're worried about a recession next year, do you want to be buying private credit and high yield debt?
It doesn't make a whole lot of sense to me. I mean, we are unfavorable on credit. I mean, credit spreads are near kind of their tights here in the trading range, like around 400 or so, depending on what index you use. It makes no sense to me. Again, if you're going to have a recession, or you're going to continue to have rates move higher on the short end, making borrowing costs more expensive, I just don't think the reward is worth the risk, quite frankly. I have to be compensated much better.
So where do you want to go?
Well,
in the fixed income world.
Sure. Short term is the easy place to hang out. You're getting paid great to hang out in the short end.
So U.S. Treasuries, U.S.
Yeah, for the most part, U.S. Yep. Yeah, because you start to get developed. You start to have the currency play, and it's not nearly as pure. We got very aggressive last October, around 4.25 on long bonds. We're seeing rates start to kind of tick back close to there. So if we saw 10s go 4.25, I would be locking that in all day long.
Do you think it's going to go 4.25?
Yeah, I think if the Fed, which I do think the Fed's
going to have... For the 10-year you're talking.
Mm-hmm, yeah, because I think the Fed's going to have to hike more, just like they've said, and that should bring 10s up a little bit. It just should lift the curve a little bit. And to me, locking in those rates, if you believe the Fed is going to bring inflation back down to 2%, locking in 4.25
is fantastic.
Right. Exactly.
Right.
Exactly. So I think it depends if you believe the Fed or not. I believe the Fed. I believe there's nothing more important to them than bringing inflation back down to their target levels.
So you think that 2% target is real and they're going to get there?
Yeah, I do. Which, again, the market doesn't believe. The market's like, maybe they'll change their mind. They'll be at the high 2s. They'll be 3, something.
Exactly.
I don't think so. I think the market's got it wrong. I really do believe the Fed is going to get inflation back down to their targets. All their credibility relies on it.
He does seem so serious about it. He doesn't want to repeat the mistakes
of the 70s.
It's hard
being a fixed income dude, though, sometimes, right?
It is. Especially
last year was much harder than this
yes.
year. No.
It's hard being anything last year, it feels like. Nice to have you here.
Thank you.
Yeah, appreciate it. Safe travels. What do they talk about in St. Louis? Got 15 seconds. What's top of mind? Are they obsessed with the Fed like we are?
Well, I think if you're in St. Louis, it's the Cardinals.
Oh, okay.
And they're not good. They're awful. And so that is the topic of conversation, and not in a good way.
All right, Brian Railing, Safe Travels, Head of Global Fixed Income Strategy at Wells Fargo Investment Institute, here in our Interactive Broker Studio. You're listening and watching Bloomberg Business Week.
Connection lost.
Your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. The Federal Reserve's hawkish remarks on interest rates has led at least one analyst to take a negative view on bank stocks after the Fed signaled future interest rate increases may be ahead. Odeon capital analyst Dick Beauvais said in a note to clients that he is returning to a stance he has mostly held for 2 years. In the past couple of years, his negative view, though, began to wobble as bank shares bounced from their lows. Today, we're looking at bank stocks, and for the most part, they are higher. Case in point, J.P. Morgan Chase up now by 1.2%. Citigroup shares up by 0.6%. Bank of America up 0.9%. Wells Fargo up by 0.7%. Deutsche Bank expects trading revenue to decline by as much as a fifth this quarter, the first major European investment bank to warn of a significant slowdown. Delta Airlines board has voted to restart the company's quarterly dividend, which was suspended in March 2020 at the outset of the coronavirus pandemic. Today, looking at the airline stocks, they are pushing higher. Right now, we have got Delta up by 1.8%. Among some of the airline names that are advancing today, UAL up by 0.2%, American Airlines up 0.3%, Southwest Airlines up by 1.2%. JetBlue, though, having a net down day. JetBlue shares lower now by just about 0.4%. Microsoft shares on pace to close at a record, becoming the third mega cap to scale new heights this year. Those are our top company stories. This is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
All right, everybody, just about 4.5 minutes left, and we're going to head over to Scarlett and Romaine, wrap up this trading day on this Thursday. Carol Messer along with Matt Miller in for Tim. on this Thursday. And one of the stories that's among the most read on the Bloomberg, it crossed a little while ago, our Steve Matthews putting out a full read on it. And this has to do with the Fed Bank of Atlanta President Raphael Bostic making multiple trades leading up to the central bank's meeting last May, revealing additional transgressions of the central bank's trading rules that have since been disclosed and are under investigation. Unfortunately, we've seen this movie before.
Yeah, he's done it before, blamed a third party then as well. But I think it's really interesting. The transactions were all relatively small, ranging from $1,000 to $50,000. It looks like there were boxes you could check, and that's the one, the range that he was in, according to these documents. He sold shares of ETFs run by Invesco and Vanguard. Of course, they're some of the biggest ETF dealers or creators in the world. But I just don't understand. You know, as a journalist, we're not allowed to buy and sell securities without reporting it, and most of us simply don't.
We just don't. We're like in, right, mutual funds or whatever, or something else.
But maybe we're the idiots, right? Maybe when you have access to this kind of knowledge, you need to take advantage of these situations.
Hold on.
I'm not making that allegation with Bostic.
Slow your roll there, Matthew Miller, because Bostic cited the same explanation in Thursday's disclosure, adding that he and his spouse, quote, held assets in managed accounts over which we had no discretion, according to the documents. They moved all of their assets out of the managed accounts last year, and it was a money manager acting on his behalf that bought and sold shares of 19 ETFs on May 2nd, 2022, according to those financial disclosure forms. Here's what I would say. Time will tell if there was anything astray here. I want to be very careful, but what I will say is if you are a member of the Fed in any form, you better make sure you are super duper careful.
Right. I think, you know, bigger
go
picture,
above and beyond.
If you're a member of the Federal Reserve Board of Governors, or if you're a member of Congress. I just don't understand how you're allowed to trade so actively.
And why are so many members of Congress really wealthy?
Yeah.
I don't understand
I think
that.
we know why.
All right. Well, that is something. Follow the money, we always say. Anyway, that story, if you want to read the full right through, just check it out at on the Bloomberg or at Bloomberg.com. We're going to count you down to the close. Beyond the Bell starts right now.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Scarlett Fu. We're counting you down to the closing bell, and here to help take us beyond the bell. It's a global simulcast with Carol Massar and Matt Miller. Welcome to our audiences across Bloomberg Television, Radio Originals, and our partnership with those folks streaming on YouTube. All 11 sectors, Carol, right now in the green. This is a broad-based rally.
Yeah.
Are you buying it?
You know, well, you know what investors aren't buying? You know what's being left out? Semiconductors.
No.
Most names in the stocks are down today, and we're looking at the overall index down about 0.75%, which I find kind of interesting because if we're all in on AI, we're going to need a lot of chips, very specific chips, but nonetheless, we're going to need them.
Yeah, absolutely. Let's take a look. By the way, Carol and I are not buying.
Okay.
Just
and I
to be
will
clear.
say the stocks is up about 50%. We are not buying.
We don't.
Clarity, full transparency.
I want to just take a look at what's going on in terms of the industry groups. Carol mentioned that people aren't buying semiconductors specifically, but they are buying the IT, they are buying industrials, they are buying communication services and healthcare. In fact, every index group in the S&P 500 is up. At the bottom, you do see consumer discretionary, real estate, materials, consumer staples, but they're all sort of up and away today, as it looks like a little bit of capitulation to the upside, maybe a little bit of short covering, because remember, S&P futures are at an historic level in terms of the amount of shorts on them.
Yeah, it's going to be interesting to see when we talk about the sustainability of the rally. Don't forget, we have triple witching tomorrow, and of course, coming up to the end of the month and the end of the quarter, there's going to be a lot of concerns about all those funds that have to rebalance given the relentless differential that we're seeing between gains in the equity market and the much smaller gains in the bond market. At least for today, a big part of the reason why you're hearing the clapping and the cheering coming from the NYSE, coming from the NASDAQ, the Dow, up more than 400 points, 1.3% to close out the day. The S&P up more than 50 points, up 1.2%, above 4,400, above all of its key moving averages, and yes, above one of those key lines in the sands on the RSI, overbought territory for the S&P. The NASDAQ has been in overbought territory for some time. Investors seem to be shrugging that off, up more than 1% on the day, and the Russell 2000 pulling up the rear with the gain of about 0.8%.
Yeah, and we've got a VIX that actually moved up about half a point at 14.39, but I'm just kind of amazing to see it at this level, so low. Many would say a lot of complacency out there.
Yeah, it does seem so, especially with regards to the Federal Reserve, right? Investors seem to ignore the dot plot and ignore the fact that Jerome Powell was so vocal about no cuts coming. Just looking through that, we just went through the GRR, but there's a visual representation of it. If you like, you can see that healthcare, as I said, communication services and industrials are the top gainers, but everybody was up.
All right, so let's get to some of the individual gainers. As you said, a lot of green there. I had a lot to choose from, so bear with me. Microsoft, I want to bring it up. Did we hit a record? We did. 348.10 is the close. The last closing high was back in November of 2021. So 348.10, that stock is up 3.2% in today's trade. It's up, what, 45%. Thank you, generative AI, in terms of Microsoft, because it's been on quite a run this year. I want to get to Lennar because it's not just about high tech in this trade, as we said. It's really broad-based buying. Lennar, the number 2 gainer in the S&P 500, a gain of 4.4%, and it really boosted the overall home builder names in the trade today, reporting better than expected orders as a shortage of previously owned homes for sale drew buyers into newer properties. So they definitely benefited. T-Mobile, we saw this a top gainer throughout the day in the S&P 500 and NASDAQ 100. Morgan Stanley putting out a note today and saying the recent sell-off offers a window of opportunity for buybacks at lower prices, creating more value for investors. The analysts there reinstating the wireless carrier as a top pick in telecom services, so up 3.7%. And Nikola, I know you're not supposed to say it that way, but it's up almost Nikola, up almost 30% in today's trade. I mean, above that key $1 level, a little perspective there.
Goodness.
I know, but it's got to comply with those NASDAQ rules. So it's closing at $140. It's up about 171% in 7 days. So 7 consecutive sessions, longest winning streak since November of 2020. Keep in mind, it's still down, I think, about 99% below its 2020 record high. So I just thought that was an interesting one.
All right, let's take a look at the decliners. It was actually kind of difficult to find, but in fact, the top 3 most actively traded individual stocks by value are decliners, or at least 3 of the 4. I'm going to start with some chip companies because AMD, NVIDIA, both falling on reports. Senator Josh Hawley and Richard Blumenthal are teaming up on legislation that would eliminate Section 230 immunity for AI companies. Basically, give consumers the ability to sue when AI harms them. That's according to Josh Hawley's tweet this morning. So we're seeing weakness there.
Harms them.
Yeah.
You
well,
know, I think we're giving far
right?
too much credit to this software. I mean, it's basically just code using data to spit back stuff that it guesses that you're going to want.
People are worried and people are excited.
So silly.
So and it's all being priced in. Amex falling as much as 2.8%, obviously paring its loss into the close after Citi put Amex on negative watch due to slowing consumer spending trends. Nike down by 0.4%. RBC cutting its price target to 138 from 145 after the stock yesterday had its biggest rally of the year. And Mersana Therapeutics is one of the worst performers in the NASDAQ composite after the FDA halted new patient enrollment in 2 of Mersana's ovarian cancer drug trials. That stock lower by 60% on the day.
Let's take a quick look at what's happening in the yield space. We've been talking a lot about the deeper inversion that we've been seeing on key parts of the yield curve. You did see buying pretty much across the curve on this day. Buying that pushed the 2-year yield down by 4 basis points, the 5-year yield down by 8 basis points. Your 20-year and your 30-year yields also moving lower by about 4 to 5 basis points. And right now, a 2s10s at negative 92. And even if you want to cherry pick some of the others, keep in mind you got a 3-month 10-year right now at negative 150.
I mean, does this feel a little heady? I mean, look at this IPO IPO, Romaine, you were talking about it earlier.
Yeah.
You know, closing up, what, 99%, so basically doubling in its IPO debut. I know that if investors were looking for new issues, we haven't had a lot to choose from, so maybe that's why it was
I think it's interesting, too. I mean, everyone's going to focus on the gain on the day, but I just thought the pricing was interesting, too, because there was a lot of talk here that this would be a real test of the market. I mean, they were coming in, I think, at 16 to 19 bucks. They ended up selling at 22. So the idea that they were able to walk around with this pitch deck and actually make it clear to people that this thing was worth more than what they were pitching. And then, of course, they end up getting a closeout on the day at around 40 bucks a share. This is still a fundamentally driven market, if not a macro-driven market. We do have earnings coming out right now. Adobe crossing the wire right now. Let's take a look at those numbers. The second quarter numbers here coming in at about $3.91 on EPS. That looks like a beat versus $3.79. 2Q revenue coming in at about $4.8 billion. That also appears to be a beat here. So a beat on the top and the bottom line here. Here's your forecast here. Your full year forecast on the EPS, $15.65 to $15.75. That range would be above what the street was looking for, and their revenue guidance also looks like it's coming in just slightly above what the street was looking for.
And in looking at the comments that the company has given, they point out record second quarter revenue, demonstrating strong demand across Creative Cloud, Document Cloud, and Experience Cloud. And Matt, you and I were talking last week about how cloud is basically code word for AI. Their second sentence goes straight to that, about how Adobe's groundbreaking innovation positions, okay, that's just corporate speak, positions us to lead the new era of generative AI, and really putting that front and center for investors to focus on here.
I just want to point out, this would be a good time to mention AI, because I thought one of the funniest stories on the Bloomberg terminal was how Kroger, the grocery chain, mentioned AI 8 times on its conference call.
In what way?
You've got to.
It doesn't matter, Scarlett.
You've got to find
AI.
a way to do it, right? I mean, this is why, to me, artificial intelligence is mainly just a marketing term, and it's been used to really good effect. But what it truly is just software code written by, a couple of people out in Silicon Valley that helps you troll through trillions of words in data.
But what if you say, listen, hey, Kroger, I'm going to make a quiche. Can you put together a list with all the ingredients I need?
Brilliant.
And then buy them and send them to
You are fancy. Just in fairness too. I mean, just
real men do eat quiche.
I just want to be fair to Kroger. I mean, they did talk about how a lot of this is more integrated into kind of their purchasing, kind of the back stuff, not necessarily the consumer-facing stuff, but like how they manage their inventory and things like that.
Well, I mean,
it's going to be boring, right?
Yeah, I think the bottom line is that you can't not say anything about AI at this point. It's not going to hurt you, and it can only benefit you, given the frenzy for anything related to AI.
What does an AI quiche taste like?
You got to watch out for those chips.
It's an AI-generated menu.
It's the median quiche.
The recipe.
No, this is like quiche Lorraine, or what is it? Where are we going with this?
Yeah, quiche Lorraine. I like my quiches simple. I don't want all that stuff thrown in there. Just a good French quiche. Hey, Neil Dutta is sending a note.
Doesn't have a lot of stuff thrown
he's
in there.
reminding us stocks aren't the economy. He says, here's what's going to happen
Stocks aren't
next.
the economy. That's bold call.
Yeah.
Yeah, great. Thanks for that.
Let's go have some wine
Public
and quiche.
service announcement.
All right, we got to wrap.
News
all
at
right,
11.
We will see you tomorrow. That's a wrap for our cross-platform coverage. Radio, TV, YouTube, Bloomberg Originals. We call it Beyond the Bell. We will see you again at 3 p.m. tomorrow.
You want runs?
No, I don't
We have
want.
runs upstairs.
I know, and you pick through the colors, right? There's what colors don't you eat, or what you do eat?
I only like orange and purple.
Okay.
Who wants green to be apple? If you have a candy and the color is green, you want it to be lime.
Okay, I guess so. All right. We'll table this for a moment. What we do want to talk about is what's going on in the markets, and we had the S&P 500 right piercing through 4,400. Microsoft closing at a new record. Who cares about an overbought market? Because that's certainly what the technicals say. So you ready to talk to Jess Manton?
Yes, I am.
You're always ready to talk to her. She's got a column. She reports that Wall Street isn't buying what Fed Chair Jay Powell and economists are forecasting, hence the disconnect, perhaps. Jess is Bloomberg News deputy team leader, and she is here in our Bloomberg Interactive Brokers studio, and of course for U.S. equities. So it feels a little heady.
Wait a second. How long have you been deputy team leader?
A while.
Well, congratulations.
Probably like almost a year, but thank you.
Yeah. Hey, Matt.
I did not know that.
Hey, Matt, thanks for keeping up.
I didn't see that.
Apparently, you didn't call me by my right title for a while, but I didn't want to correct you.
Why not?
It's like, it's fine.
Oh, my God.
I'm also a reporter, so he got it half right.
All right. So tell us about your reporting and what you found out.
So this was something I had been working on for a while now, and obviously, so say you look at the ECFC function in the terminal, because I know Matt always likes to use those types of functions. You go through and you look at what economists are projecting. It's always been a little bit all over the place this year, but on a quarter-over-quarter basis, you can see how it looks like there's just a mild contraction for the third and the fourth quarter, but when coming into this year, it keeps getting pushed back further and further. There's a lot of arguments.
It's a recession that's never going to happen. No, I'm sorry.
Right, and well, not necessarily. It's more of these expectations keep getting pushed back, and then also this argument about whether or not is it actually a recession, or are you just in a more regime for a slower growth? But then also, what about the consumer and consumer spending, which obviously is what is more than 2/3 of what's pushing the economy, and we just got those retail sales number this morning. So then how does this translate right into the stock
Let's
market?
walk through those retail sales numbers, because I don't know if everyone
they were strong
was typing EcoGo at 8:31 a.m., but
I mean, there was a lot going on, right? Post-Fed decision, ECB,
Exactly.
PBOC. We also have Bank of Japan overnight.
But basically, they were stronger than
Right.
almost every single economist that we surveyed had predicted.
They were. And so even though we've seen different iterations in some of the data where maybe consumers have given up some of their savings, but then maybe still hoarding some cash in other places like money market funds, right? Still, the strength of the consumer there. So really, the argument on the recession case would have to be a huge pullback there, and we're just not seeing it yet. And there's a lot of, when you're looking at investors, clearly not buying when it comes to Powell's sort of jawboning yesterday with what he said after the Fed decision.
He had a few
really brushing
scotches
that
when he
off.
got home, don't you think so? Or gummies? No, I can't say that.
Yeah, you can. It's legal.
Yeah, I guess you can. But it was I think it was a tough press conference. As Mike McKee said, he was in a kind of cranky mood. He had to kind of.
But also,
data dependent.
a lot of
maybe
people
not.
I've been speaking with were saying that he couldn't necessarily come off and just say, "Hey, this is it," because the markets would have just completely shot higher. So it was almost like he was forced to have to really deliver sort of this really hawkish rhetoric in order to have some sort of flexibility and options in case something unforeseen happens, and they might have to go back to that. But I know you always like to look at Bloomberg Intelligence data from Gina Martin Adams.
We had her on earlier.
Yes,
too.
so did she talk about the skip pause different scenario and what it means?
No.
She talked about
What's your take on that?
Yeah,
Hold, skip, pause.
Because she talked about margin stabilization and improvement for earnings.
Right, and that was the big
Yes, she did
caveat of whether or not the trough, the worst of the pain would be passed, and obviously that bodes well for if you're looking at the trajectory of earnings, especially because we've talked to her a lot when you exclude energy. If you would have looked at last year, obviously the earnings recession would have already started in the second quarter of last year, so do you have the flip side of that to where energy is kind of masking what could be helpful there.
So the run-up in equities is basically saying, yeah, okay, Jay, you're going to raise rates, whatever. Or economists, you think we're going to go into recession, whatever. I'm buying stocks because I think things are better.
Well, also, typically, if you look back in history, the market's going to bottom well before, obviously, a recession ends up getting called. And I know that, Matt, you like to follow Sam Stovall over at CFRA, obviously, encyclopedia.
He joined us recently.
Yes, and so he has tons of data on that. And so they're just not necessarily buying the recession argument right now. But Doug Ramsey over at Luthold, he tends to be a bit more bearish. But even coming into this year, he was still adding different exposure and loosening some hedges just because he's still betting that there will be a recession because he's watching very closely with that yield curve argument that he thinks would point toward maybe some downdraft happening in September. But he was still positioning to have that exposure toward equities. But once you get closer toward the second half of the year,
what does the
he's
market?
On the defensive side.
What does the market? When does the market start to discount a recession, or does the market fall after a recession? Because even if the recession, if we know a recession is going to happen, say in Q2 24, does that mean we should be selling stocks now? No,
so
right?
That's the biggest thing because typically the S&P 500, if you look back in history, never bottoms before a recession. So that's what makes all of this very tricky for people.
Doesn't bottom before a recession.
No.
Or never have. Okay.
No, yeah, right. So it never has bottomed before a recession. So that would mean either worst of the pain has passed or more pain is to come. And so Bloomberg Intelligence, Gina's team has that economic regime model where they were arguing most of the economic pain. And they're looking at, say, sentiment indicators, utility capacitization. Actually, they said the worst of the pain already was behind us.
Yeah.
And I did this story actually 2 months ago. I talked to Matt about it on radio. And so that kind of ruffled a lot of feathers because last year, the first 2 quarters, there was a contraction in growth, but a lot of that was trade related. It wasn't necessarily related to a drawdown in the consumer. So typically that was argued as a one-off. But if you go back to the 1940s, there hasn't been 2 back-to-back quarters of contraction where there wasn't a recession. But the National Bureau of Economic Research, it takes a while before they'll actually call that. So if you're an investor, you're not going to wait on that to be called. You're going to want to move before that.
Are you saying, okay.
So the recession maybe already happened, and because we had such high household savings due to the stimulus, because we had all the corporates had already gone out and refied at zero, they don't need to do that again, because we have a service sector that continues to plow forward, especially post reopening,
and more money coming from stimulus in terms of government programs.
Everything seems like it's going to be fine, right?
And then you look at what's happening with money market mutual funds as far as just the amount of, if you want to call it, cash equivalents on those sidelines. A lot of it also has to do with not necessarily defensive positioning, but if you can yield 5% or more, there's a different kind of argument as far as why investors are doing that now versus coming out of, say, the housing crisis and what they were doing the last decade or so.
It's interesting, though. Can we take the earnings recession that happened and just say that was it?
Well, if you...
And we had a growth recession. We had 2 quarters of contraction.
Oh, right, during the pandemic, right?
Well, no, at the end.
Oh,
right. Toward
last
the end.
year.
And so now, if you're looking at those earnings projections excluding energy, if you don't want to see what that's masking to the earnings growth, it's actually on track back to growth in the second half of the year and double-digit growth a year from now. But then also you have to rectify if GDP is going to come down, how do you square that away? And that's something that is a debate right now in the market.
There's a lot of ifs and buts there.
Right.
All right. Well, it's fascinating nonetheless, Jess, to see, us go through 4,400 and especially the rally in the last kind of hour of trading.
And people got the trade so wrong.
Well, have you seen, and I put the chart on our chat a little bit earlier, so I'll scroll. So the chart is 72.75. If you look at #BTV 72.75, you can see that there were record shorts, or there are record shorts in S&P 500 futures.
Right.
And what I'm thinking is today maybe it was a little bit of capitulation of those shorts or short covering, as the rest of the market was going up, these guys had to cover.
Right, and there also have been record shorts in the bond market, particularly when you're looking at the 10-year as well as the 2-year. And so the argument there is those would be on expectations that yields would move higher, but such extreme positioning could have the opposite effect and push yields lower and then be a boon for the stock market. But right now, if you look at the positioning, discretionary investors, so those portfolio managers that can more adjust that type of positioning, are now overweight equities for the first time since February of last year.
That's a little wacky.
Carol's just, her eyes have glazed over at this point.
Kind of am,
She can't anymore. She just can't.
Don't you ever remember, you're taking an exam and, you get through it, you just get to your point, you're like...
I love that scene in Ferris Bueller when, the guy, pulls his face off the desk and there's a string of, slobber.
Drool.
Yes, that's exactly...
I love you, Jess. It's interesting. Well, certainly the enthusiasm and the bulls were out in full force. Jess Menton, she's deputy team leader for U.S. equities at Bloomberg News. Check her out on Twitter at Jessica Menton. And of course, her writing, it's a must read on the Bloomberg terminal at Bloomberg.com. This is Bloomberg Radio.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street, and we do check markets all day long. Here at Bloomberg, we begin with a developing story. Christine McCarthy is stepping down as Disney's chief financial officer. The Disney interim CFO will be Kevin Lansbury. Also, Millicom ending talks with Apollo, and we got earnings out of Adobe. It is boosting its revenue forecast for the full year. After hours, shares of Adobe, they're up now by 3.2%. But again, repeating the Disney headline, Christine McCarthy stepping down as Walt Disney's chief financial officer. The stock rally deepening beyond the AI-fueled craze. The Dow, the S&P, and NASDAQ all rallied today. S&P up 53 points, ending the session at 4425, a gain of 1.3%. The Dow today up 438 points, up 1.3%. NASDAQ up 156, up 1.1%. Microsoft at a record today. NASDAQ 100 index up by 1.2%. The 10-year yield, 3.71%, with a 2-year that's yielding 4.61%. Gold up $15 the ounce to $19.58, up 0.8%. And West Texas Intermediate crude up 3.4%, $70.57 a barrel. So again, recapping, stocks higher today. S&P 500 index up 53, a gain of 1.2%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Charlie mentioning Disney in the after hours. Their CFO, some changes there. Stocks just down about 0.5% in the aftermarket. All right, we do want to welcome our Boston audience today, joining us on Bloomberg 106.1. Great to have you with us, and looking forward to you joining in every day, 3 to 6 p.m. right here on Bloomberg Radio. All right, we want to talk a little bit about something our Bloomberg Business Week Pursuits team, Matt, covered in a big way earlier this year. It's about the market for sleep tracking devices. Some $14.5 billion, projected to reach more than $61 billion by 2030. This as a staggering 50% of the population is sleep deprived. You are not.
Well, here's the thing. I slip on a sleep tracking device every night because over the past couple of years, I've had to wake up at 2 o'clock in the morning every day for my early show appearance. And so I wanted to make sure I was tracking my sleep and hopefully getting enough to survive. I only averaged about 6 hours a night over the past couple of years.
Those schedules will do
But
it.
since I've dropped that schedule a month ago, I've been averaging more than 8 hours a night. And I feel fantastic. Like I've come off of an acid trip. Like I can actually think clearly again. It's unbelievable the difference in cognitive, power between being sleep deprived and getting your full solid 8 hours.
Well, that's what we want to talk about with Adam Spira. He's professor in the Department of Mental Health at the Johns Hopkins Bloomberg School of Public Health, supported, as you know, by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Adam joining us on Zoom from Baltimore. Adam, I couldn't agree more with Matt. If I get a good night's sleep, the world is mine. When I'm not, it feels like everything just hurts and everything's a problem. So talk to us about the importance of sleep and why we're not all getting better sleep and more sleep.
Yeah, well, you're absolutely right. Sleep is connected to so many aspects of our health and wellness, from our mood and emotions to our ability to think clearly, to aspects of our metabolism, to cardiovascular health. You name it, sleep is linked to it, and good sleep supports good health more broadly. And yes, a substantial proportion of the U.S. population is sleep deprived, and some of us are doing that because we do not have the opportunity to get the sleep we need due to schedules, demands on us from work, or the social environment like family or caregiving, or you name it. Some of us are not getting enough sleep because the neighborhoods we're in have noise pollution or light pollution. Some of us are not getting enough sleep because we have frank sleep disorders like a clinical insomnia disorder or sleep-disordered breathing or sleep apnea. So there are many, but then there are others of us who voluntarily forego sleep because we want to binge the rest of that series, or we are on social media. So a lot of us are not getting
That's
enough
Carol,
sleep.
by the way.
Yeah,
Carol has no
What's that?
excuse,
Well,
basically.
It's so funny because my husband would be like, you need to have a schedule. I think about my dad. He was like so disciplined and up at the same time, went to bed at the same time. I'm not good about that. How much of that is a bad thing? Like you need to have some kind of regular schedule.
Well, so if you have a sleep problem, we recommend that one of the first things that you do is set a good standard non-varying wake-up time. So you wake up at the same time every day. If you have insomnia, for example. And that really supports good sleep health. It is really important.
All right, so we wanted to talk about the link between sleep problems and Alzheimer's disease, or sleep problems and dementia. And I wonder if it's kind of a chicken and egg thing. Do people who have sleep problems, are they more likely to develop dementia or Alzheimer's disease? Or is it people who already have Alzheimer's disease or already experiencing dementia, they then have sleep problems?
Well, I think that you hit the nail on the head. It's a bidirectional relationship is how we're really thinking about it these days, where people we used to think when we thought about sleep and Alzheimer's disease, we used to think that sleep disturbances happened in people with Alzheimer's disease because their brains changed. And people who either care for people with Alzheimer's disease or clinicians who work with them, family members who might have someone with Alzheimer's disease in the house, become quite aware of the significant sleep disturbance that is really common in that population. So that was the direction that people first thought about, but really over the last decade or so, a little more than that now, people have really come to realize that sleep disturbance is associated with an increased risk for dementia and could well play a causal role in promoting dementia and Alzheimer's disease in particular.
All right, so people who have no excuses. If your kids are in college, if you don't have to be at work at 5 o'clock in the morning, you should put down your Twitter, stop watching your Netflix, and go to sleep.
Yeah, I get. He's right. I get them. No, it's just. But why is it that though we have a harder time falling asleep as we get older? And like I, as a kid, would sleep until 11 or noon on a Saturday. Easily. I can't do that anymore.
Well, so you're talking about two different things which are really interesting. So we do notice, and oftentimes you mentioned when you were a kid, teenagers notoriously get mislabeled as lazy because what they end up doing is they can sleep a really long time. And when we're younger, our need for sleep is greater, and the clock in our brain that basically tells us when to sleep and when to be awake is basically telling us to go to bed later and to wake up later. It's what we call a circadian phase delay. And that is one of the reasons that there's been a big push nationally
for schools, right?
By sleep advocates to move school start times later. But you asked another question, which is as you get older, and I assumed you didn't mean from child adolescence per se.
No, I was asking this for Matt because as he gets older, I'm worried about him.
Yeah. Oh yeah, well, me too. But as people get older, from middle age to older adulthood, they tend to, there are some changes that we believe just happen as part of the aging process, where our sleep gets a bit shorter, a bit more fragmented, and it becomes, importantly, lighter. We don't have as much of that deep restorative sleep. It's harder for us to get. And we think that that happens even in the absence of medical conditions, chronic medical conditions. But way more people have sleep problems than would be accounted for by those normal age-related sleep changes when you look at older adults. And really, the big drivers of those, we think, are medical problems and medications we take for those problems. That's a big driver of why we develop them. But it's not the only driver.
What do you think about sleep trackers, by the way? We opened up talking about, I wear an Apple Watch, but there are a number of other products out there that purportedly track sleep. I think looking at the data and assessing, my experience with it, the Apple Watch does a pretty good job, but I noticed I only go into deep sleep for the first 30, 40 minutes of the night, and then I never go back there again. And I don't know if that's because the watch isn't very good at tracking the stages of sleep, or because I really only experience deep sleep at the beginning of my 8 hours.
So this is really a great point. There are two sort of issues here. First of all, we do, under normal conditions, spend more time in deep sleep in the first part of the night and less as the night wears on. And conversely, we spend an increasing amount of sleep in REM sleep when we do most of our dreaming as the night goes on. So your watch might be right about you spending more in the early part than in the late part, but I will say this about sleep trackers. The only way that you can definitively tell if someone is awake or asleep is by putting electrodes or some sort of a sensor on their head so that you can detect electrical signals from the brain. That is the definitive gold standard measure of sleep. In the absence of that, we cannot rely solely on devices for truth, for ground truth. Is this person awake or asleep?
Right.
So that being said, for decades now, sleep researchers have relied on devices that we've referred to as actigraphs a lot of the time. And these are accelerometers that you would wear on your wrist. And they used to be clunky analog things. And they've developed to be quite sleek. And now, and they basically are accelerometers they capitalize on the fact that people, and animals as well, by the way, move less when they're sleeping in general.
Yeah.
Right? And so yeah. But those devices, those trackers, they're not all created equal. I would put it that way and say, so that's something to consider.
I need to get some brain electrodes.
All right, you've got to come back soon because I have still a million questions. So Adam, I feel like it just relates. We all can relate to this. Adam, really enjoyed it. Adam Spira, professor in the Department of Mental Health at Johns Hopkins Bloomberg School of Public Health, joining us from Baltimore. I mean, when I go to sleep, I'm like head to toe with stuff. We'll talk about it later, maybe.
What?
All right, right now, let's get a check on world and national news. Off to D.C. we go, and Nancy Lyons. Hey, Nan.
Thanks, Carol. Defense Secretary Lloyd Austin is urging nations to keep up support for Ukraine as the country kicks off a counteroffensive against Russia. Former U.S. Secretary of State Henry Kissinger agrees Ukraine must be supported. He spoke with Bloomberg editor-in-chief John Micklethwaite.
It is important for Ukraine to be preserved and for Ukraine to emerge from the war as an autonomous, strong, and democratic country.
You can see the entire interview with former Secretary of State Henry Kissinger tomorrow at 7 p.m. Wall Street time on Bloomberg Television. President Biden says he's following through on his State of the Union promise to eliminate junk fees that consumers often face. Today, the focus was on ticket brokers like Ticketmaster and Live Nation, who will now be more transparent.
The solution is what is called all-in pricing. And that's where companies fully disclose their fees up front when you start shopping, so you're not surprised at the end when you check out.
Biden says Live Nation is promising to implement the policy beginning in September. Former New York City Mayor Bill de Blasio is being ordered to pay almost $500,000 for using city money for his security detail during his short-lived run for president in 2019. De Blasio never garnered more than 1% in the polls and eventually dropped out. A Muslim woman will serve as a federal judge in the U.S. for the first time ever. The Senate today confirmed Nusrat Jahan Chaudhry for a federal judgeship in New York. And at the U.S. Open today, Ricky Fowler broke the Open record with an 8-under 62. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:40 on Wall Street. We do check markets all day long at Bloomberg. The Dow, the S&P, NASDAQ all rallied today. Moments ago, we did hear from Adobe. It is raising its full-year revenue and profit outlooks on optimism that generative AI features will spur demand for its software. Right now, we've got shares of Adobe higher after hours by about 3.4%. The stock market rally continued today with the S&P up by 53 points, a gain of 1.2%. Dow Industrials up 428, up by 1.3%. NASDAQ up 156. For NASDAQ, that was a gain today of about 1.1%. So the Dow, the S&P, and NASDAQ all advanced. Brian Railing is head of global fixed income strategy at Wells Fargo Investment Institute, and he was our guest moments ago right here on Bloomberg Business Week.
I think, quite frankly, the stock market, I'm a fixed income guy, but the stock market to me seems to be, it's kind of in a summer fling, quite frankly. Bad news is good news. Good news is good news. Any type of news is good news. It just wants to go up.
10-year yield, 3.72%, with the 2-year yielding 4.64%. Spot gold up $15 the ounce to $19.57. Gain there of 0.8%. West Texas Intermediate crude up 3.3%. $70.54 a barrel. Microsoft shares rallied today to a record up 3.2%, becoming the third mega-cap tech firm after NVIDIA and Apple to scale new heights this year. Again, recapping, stocks higher. S&P today up by 53 points, ending the session at 44.25, a gain of 1.2%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You are listening and watching Bloomberg Business Week. Carol Massar along with Matt Miller live in our Bloomberg Interactive Brokers studio. You might remember from the last monthly read on the U.S. labor market, it showed that the unemployment rate increased for Black people from April to May from 4.7% to 5.6%. Black women were the most affected, specifically those who work in the public sector, again, according to the Bureau of Labor Statistics. Their unemployment rate increased from 4.4% in April to 5.3% in May. That's a pretty big jump. And Matt, there's a new documentary that tracks the paths of 3 Black women, all single mothers, who found a better way forward and jobs in the process. Check it out.
We want them to find a job and then a better job and then a career.
To imagine myself in a career opposed to just a job was definitely far-fetched.
My kids very proud of me. They know that I was working very hard just to change our life.
The journey has changed my life in a way that I could have never envisioned.
All right, again, a new short documentary film. We want to get to the executive producer of video content development and production at the workforce-focused nonprofit Working Nation. She's director of the short, Melissa Panzer. She's with us on Zoom from Los Angeles. And forgive me, they were 3 women of color. I just want to clarify that. Melissa, good to have you here with Matt and myself here. Tell us a little bit about this documentary. We have, of course, heard a little clip, but tell us about these 3 women.
Sure. Well, first of all, Carol and Matt, thanks so much for having me this afternoon. These women are just an incredible story, all 3 of them. There's one woman who immigrated from Jordan who's featured in the film. She didn't speak any English when she arrived in the United States. She lived in a domestic violence shelter for 42 days. Upon arrival, her husband kicked her and her children out of their home. I mean, it was really, really a horrible situation for her. And she learned English and got herself educated and was able to go to this Goodwill program. And we feature her in our story. And, we feature her and 2 other women of color, both Black, who also just fell on really hard times. And they all found this program that gave them short-term quick credentials to get access to really, really remarkable jobs. And it was really an opportunity for them to change the lives of their families, their children. They're all single. And now at the end of the film, you hear one of them saying, I how much money do you make now? And they're joking around, and it's quite a bit. It's quite a bit. I mean, they're making at least $80,000 a year kind of thing.
That's quite a turnaround. Melissa, tell us about this program with Goodwill that you guys are doing. Exactly what's the reskilling that's going on?
Yeah, so it's an IT training program that Google supports, and Coursera helps with the curriculum, and it's offered at Goodwills around the country. We filmed in Nashville, and it's really short-term certifications that gets folks access who maybe don't have the kind of IT training that you'd expect to need to go into one of these IT jobs. And it's free as long as you qualify for it.
I mean, it's really an incredible story of hope. A story of hope for anyone, right? It's the Goodwill Digital Career Accelerator. Is it only accessible now to women or women of color, or can anyone skill up with this program?
No, I'm pretty sure you have to meet you have to be under a certain financial sector,
right,
to access the program for free. But it men, women, people of color, white folks, it really doesn't matter.
And I mean, does it just teach you skills to learn a specific job? Does it teach you general skills and then you go and apply for jobs? Does it help you do the application for jobs as well? Do you have programs with employers?
Yeah, so Goodwill, something I learned while I was filming this documentary, Goodwill really sees themselves as a handholder from the beginning to the end. So of your life. Once you enter a Goodwill job center, you are a client of Goodwill for forever. And so they help, once you've graduated the program and you have your certification, they most certainly help you with job placement. If that job doesn't work out and you need their help, you go right back and they'll help you again. And for example, in this piece, two of the women, Shahira and Kara, they both work for Accenture. And that's by way of a relationship that Goodwill has with the local Accenture offices in Nashville.
Well, I think about what you guys do at Working Nation, right? It's looking at what are some of the big workforce issues. And right now we continue to see, despite, we got jobless claims today, we still see a tight labor force. You bring on any leader, and that's what they're going to talk about. I'm still kind of fighting for talent here. Earlier in the week, we talked about nurses and the shortages there, the dynamic and fighting for them. But I do wonder, from what I understand, the Goodwill Digital Career Accelerator, done in a partnership with Google, they provided $29 million in funding and grants from google.org. But I do, here we are spending, we're going to get into our Bloomberg Business Week magazine, which is all about artificial intelligence. And, we've heard people on our air, talking about if you are in any way trained in the world of AI or coder or what have you, you are in demand. But Google and other high-tech firms have got to be increasingly and continuing to think about their workforce going forward, and a program like this can certainly help them in terms of training individuals with the right skills.
Yes, 100%. I mean, no matter what happens in the future, as we transition into a new age of digital technologies with AI, as an example, we'll always need people who are, well, at least for right now, we'll need people who are managing those technologies and thinking bigger and better. And something we keep hearing, and the reason I think programs like this, giving access and accessibility to women like Shahira and Kara and Chelsea, is because you only know what you know. And, underprivileged Black women and women of color know what they know. And so they're giving the IT world access and eyes into perhaps things that they aren't thinking about when they're building new technologies.
Right, exactly, right. If you start to kind of open up a window and say, hey, listen, if you do this, here's what you can kind of move towards. It's something that they probably weren't familiar with. Melissa, thank you so much. Really appreciate it. Melissa Panzer, she's executive producer of video content development and production over at Working Nation, as we said, the nonprofit, and they do focus on workforce solutions, joining us on Zoom from Los Angeles. And again, of course, that short documentary. Interesting.
Yeah, very interesting stuff.
Right.
And I think provides real hope. It's great that they have programs like this, and I love to watch documentaries like this. So congratulations
really
to
do.
Melissa. I
Yeah.
really do like them.
Yeah, and I think about, I feel like for years too, we talk increasingly about, the tech sector. They're thinking about their workforce and like tapping into, middle schools, high schools to make sure kids have the right training. You are listening and watching Bloomberg Business Week on this Thursday. Carol Massar, Matt Miller. This is Bloomberg.
Your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. We've got Adobe rallying now by 4.3% after hours. Adobe is raising its full-year revenue and profit outlooks on optimism that generative AI features will spur demand for its software. Shoemaker Rockport has filed for bankruptcy protection for the second time in 5 years. The company blames current troubles on a back-to-work sales surge that didn't happen as the COVID-19 pandemic waned. Tesla started offering 3 months of free fast charging in the U.S. with the goal of clearing inventory of Model 3 sedans before the end of the quarter. And with more on that story, here's Bloomberg's Denise Pellegrini.
Charlie, the offer on the new Model 3 cars, it applies to customers who do take delivery by June 30th. And the company, Charlie, is offering this perk even after all versions of the sedan became eligible for that full $7,500 federal tax credit. credit in the U.S. earlier this month. Investor concern about Tesla producing more vehicles than it's been delivering has dissipated recently as the car maker has scored some big wins with its formerly proprietary plugs. Earlier this week, several charging companies joined Ford Motor and General Motors in embracing Tesla's North American charging standard, and it does look increasingly poised now to live up to the billing Tesla gave its plugs when the company invited competitors to start using them. Charlie.
And that's Denise Pellegrini reporting. Tesla shares today on an update for the rest of the market. Tesla was down by just about 0.4%. Those are some of the company stories we're following this hour. I'm Charlie Pelleton. This is Bloomberg.
This is Bloomberg Business Week with Carol Massar and Tim Stenivek on Bloomberg Radio.
Matt Miller in for Tim Stenivek this summer. Carol Massar sitting by my side. We have a lot coming up, including, don't think we forgot about AI. We're going to talk about...
We're going to talk about it, yeah.
I don't love the term, though, anymore.
AI?
I've decided I feel like it's a jargony marketing
Let's see what Nancy Lyons has to say about it.
Let's get over to Nancy Lyons right now. She's got her world national news in the Bloomberg 99.1 newsroom. Nancy?
Thanks, Matt. Defense Secretary Lloyd Austin is again in Brussels consulting with allies on the provision of advanced equipment and training to Ukraine. Bloomberg's Surf Chapman has more.
Austin was asked about reports that Ukrainian forces on the offensive are suffering heavy losses, including vehicles and equipment.
I think the Russians have shown us that same 5 vehicles about 1,000 times from 10 different angles. The Ukrainians have the ability to recover equipment that's been damaged, repair where possible, get that equipment back into the fight.
Austin said Ukraine continues to need ground-based missile defense, and training for both its forces and pilots for forthcoming F-16 aircraft is going forward. In Washington, Irv Chapman, Bloomberg Radio.
Multiple investigations are opening into the PGA Tour's planned merger with Saudi Arabia's Live Golf. Just as the U.S. Open gets underway in Los Angeles, Senate Finance Committee Chair Ron Wyden has launched a probe, and the Wall Street Journal is reporting that the Justice Department has told the PGA it will investigate possible antitrust concerns. We get reaction from Bloomberg Intelligence senior litigation analyst Jennifer Rhee.
I think there's a solid chance this deal won't go through. I mean, as I said, superficially, at least on its face, no matter what the structure is, it looks like a monopolistic entity taking out a nascent competitor from the market.
Jen Rhee with Bloomberg Intelligence says it's still not clear whether the PGA Live deal is a merger or will create a separate entity. Speaking of the U.S. Open, it is underway, and we've got some history being made. Ricky Fowler and Xander Schauffele are tied at the top of the leaderboard. They've made history by closing the first round with an 8 under 62. That's a new Open record and matches the Majors record. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Carol and Matt.
All right, Nancy, thank you so much. Nancy Lyons in our D.C. newsroom. All right, I got to say, I'm very excited about the next hour, especially talking about the new issue of Bloomberg Business Week, because there's a great story. I mean, was it Kroger, AI? Like, everybody's talking about it.
There's so many great use cases, even though, as you know, I feel like it's really just...
Are you a believer?
I mean, I'm a believer that this software can do really cool things, yes.
Don't you think it can do productive things?
Yeah, very productive stuff. I mean, imagine if I could tell the Bloomberg to make me a chart of 3s, 10s, inversions going back to the last 100 years.
We were just saying that,
and
right?
Color the recession periods red.
How cool would that be?
Amazing.
Right? Create a portfolio of XYZ, but just talk to it, and it's just done.
Yeah.
Right? We don't have to put anything in. In the meantime, I wonder if it can make us ChatGPT or something, or AI will figure out a way to get us cheaper tickets to see Lionel Messi or Taylor Swift.
I don't think so, no. Well, yes, maybe in that you fly somewhere else.
Right.
To go see them, right? So I have a friend whose kid wanted to see Lionel Messi when he came to New York, but the tickets were $5,000. So his dad said, "Hey, listen, I'm going to take you to see him in Nashville or Charlotte or something, and we can get the flights, the hotels, and the show cheaper than we would for one ticket here in New York." And the same thing, obviously, is happening with Taylor Swift or Beyonce around the world.
So listen to this. Tickets for Messi's potential debut in Miami are going for about $2,600 on average before fees on SeatGeek.
So that's better than New York, apparently.
Yeah, see, but wouldn't it be really cool? Like, where's the cheapest place I can go to see Lionel or see Taylor?
You know, you could probably pose that question.
And then they create the whole program, like stay at this hotel. What?
To the Bing-powered AI, but not to ChatGPT, because it always says, my database is limited to 2021 and before, so, you know.
Please don't ask me that.
Yeah.
You're freaking me out. You're going to get freaked out. No, you're going to actually get some clarity when it comes to AI, because the new issue of Bloomberg Business Week, folks, it's all about it. So Matt and I are coming back. The real thing, not deep fakes. We will be here right on Bloomberg Business
I might be
Week.
an avatar.
With legs? This is Bloomberg.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
Hi, everyone. Bloomberg Business Week continuing on this Thursday, live in our Bloomberg Interactive Brokers studio. We are on YouTube. We are on Bloomberg Originals. We could actually do a deep fake of Tim, and the three of us could be here.
Yes, of Tim